2018, we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York, this is Bloomberg Surveillance. Here's your morning headline from the Bank of America team in a fund manager survey. There is no reason to be bearish, and maybe that is the only reason to be bearish. Get your head around that. Equity futures up 0.5% on the S&P 500, up 19 points on the S&P, 39.50. Unreal. This rally just keeps on going. For the Russell, up about 16%, 16% higher year to date on a Russell in the small caps. Just unbelievable. Up another 0.9% on the session. All of this is happening whilst this is happening. Switch up the board. 2s, 10s, 30s in the bond market. Your 10-year yield approaching 125, 124.84. Up another 4 basis points on a session. So we can do it, can't we? Yields can go higher, and the equity rally can continue. More on that a little bit later through the program. Let's finish on this board here on crude, on WTI. Story arguably of the last couple of weeks as well. The crude rally continues, approaching a 60 handle on WTI. Two shocks here, one to supply, one to demand, and they're both going in a way that makes it a bullish move for crude. 59.86. Tom Keene up another 0.7%. Crude shifting higher once again.
Yeah, West Texas Intermediate almost up to $60 a barrel, John, and Brent crude reaching out 63.24. And again, some of that the market, and some of that this hellacious storm in the Midwest of the United States. Yesterday, when I heard of the seriousness of the storm, I said, get Rob Carolyn. He is Bloomberg meteorologist, and he has a wonderful sense of history and scope and scale of these storms that affect us all. Rob Carolyn, thank you so much for joining us on short notice this morning with all your radio work worldwide. Rob Carolyn, the difference is the distances of the Midwest, the agriculture of the Midwest, and the winds. This is not an East Coast nor'easter, is it?
No, this is a piece of the polar vortex, Tom, that dropped down over the Dakotas, Minnesota, and Montana last week and produced temperatures as cold as 35 below. Over the weekend, it dropped through the central United States, and it is now residing there. It's prevented from moving east because of a big high-pressure system over southeastern Florida that's producing temperatures in the 80s. So the cold air has nowhere to go. It has just sunk into the central United States. It's sitting there. Temperatures this morning are in the single digits in the Texas Panhandle, around 0 this morning in Dallas, near 20 in Houston, and even down towards Brownsville, it's 20 to 25. Right. Yesterday, the entire state of Texas was under a winter storm warning. In 30 years of doing this, I have never seen that in my career.
Rob, on the agriculture front, are we modernized and removed from 1949 and 1888, I believe it was, or is it the same old, our agriculture is exposed?
Well, agriculture is exposed, Tom, but not as much as in the past. In 1989, we had a cold outbreak through the central United States, almost as bad as this in December. So that did teach some lessons, but unfortunately, you can only prepare so much. Yesterday, temperatures in central Nebraska were 33 degrees below zero. That wasn't the wind chill, that's the air temperature. And this morning, folks are waking up across Oklahoma and Kansas. The temperatures generally between 15 and 25 below. And once again, we're dealing with temperatures as cold as 25 to 30 below across Nebraska. So there's only just so much you can do when it's that cold.
Rob, John was talking earlier about how this has been thought of previously as a tail risk. Is it increasingly not a tail risk? How common are these extreme events getting?
Well, it's not so much that they're common. We knew there was going to be issues this winter because of two things that were going on in the atmosphere. First of all, we had a La Nina in the Pacific, so that exposes the central United States to begin with to a colder than normal weather pattern. We see that historically with La Ninas, so we knew the central and northern plains were susceptible. The second thing was we had a major disruption of the polar vortex that started in December and continued through the month of January. Now, we were fortunate here in the United States through January because the disruption put the cold air in Europe, it put it in Central Asia and across Siberia. But because that disruption continued into February, a piece of the polar vortex was able to break free, drop our way, and with the central United States already being colder than normal, we've seen these exceptional cold temperatures this week.
Rob Carolyn, thank you so much for the perspective of this ongoing storm, our Bloomberg meteorologist. John Farrow, so much other news. We'll get to Gideon Rose in a minute. John, that Italian headline speaks volumes.
Yeah, unreal. Italy with a 10-year bond auction, a bond sale that draws a record demand of more than 110 billion euros. Why? Because they'll offer you 53 basis points, Tom, on a 10-year.
Just screams 2006.
That's the story, right? Where's the income? Where's the yield? And right now in Europe, it's still in Italy, just about.
And, you know, John, we see it in the negative yields. You mentioned Germany earlier. I've got a 0 and a positive statistic on Swiss 20 as well. I mean, you wonder how Europe reacts coming out of deep negative yields.
Well, what's interesting here, Tom, is that bund yields are going one way and Italian yields are going the other. And I think the ECB will be comfortable with that. They'll be looking at the spread, and the spread's getting tighter and not wider, the periphery moving in the right direction. For me, I also think it's important for 10-year treasuries as well. Many people will be asking the question, can we go it alone in the treasury market? I don't think we can. To get 10-year yields to go higher, I think you need the rest of the bond universe to come with it. And right now, the bunds are playing ball.
Yeah, we're going to do much more on this with futures up 20 in a minute. Right now, we're going to switch back to what is a monthly visit and a required visit. Gideon Rose is with the Council on Foreign Relations, their distinguished fellow and guides foreign affairs. Just a superb job of resurrecting the magazine into immediacy. And the immediacy is the decline and fall. Can America ever lead again? And you nail it, Gideon, with a chapter of fragmented power. How fragmented are we?
We are Humpty Dumpty, and we are just beginning to put this slightly back together with crazy glue and hoping that it doesn't fall down again before the glue sets.
Gideon, can you give a sense of the import of having a global leader right now as we still have a pandemic very much in the forefront with mutating strains and the idea that this is here to stay?
Well, the pandemic emphasized that there was a real world out there that bites back, and that government is not just a game that Americans play with each other, and that politics isn't just a rhetorical blood sport. There are consequences. There are policies. Most people used to think that government is supposed to do something to protect the people from external dangers, internal dangers, and advance their interests. And when the government didn't do anything about the pandemic, at least in the short term, it seemed to fundamentally challenge that entire notion. And the world looked on and said, you guys aren't just supposed to be the government of the United States, you're supposed to be de facto running the world as well. And when the world just basically was left to go to its own devices, like Lord of the Flies, under pressure, everybody went to their own national interests, and essentially the world started to fragment. And the order and the team that the United States had been leading for several decades, ever since the end of World War II, fitfully, haltingly, in different ways, started to break up or stagnate. And the question now is, okay, there's a captain who's back in, you know, Dennis Rodman's come back from Las Vegas and is partying, and now the Bulls are ready to play, and something's actually going to happen. what's going to happen? The world is watching to see if the United States can regain its consciousness as a mature, responsible government, both domestically and internationally. And so far, they don't necessarily like every single policy, because you're never going to find every single policy, because there are a lot of players in the world. But so far, people are breathing a sigh of relief that some of the craziness seems to be over.
Gideon, let's fold in this conversation to the vaccine rollout. Do you think the vaccine rollout of the last, say, months or so is bringing countries further together or pushing them further apart?
Well, I would say right now it's pushing them further apart because everyone's sort of vying to get the vaccines, and it's sort of crawling over each other to try and get the vaccine on the line. So it's a beggar thy neighbor type situation. But over time, as the vaccines actually kick in, as we start getting something approaching herd immunity down the road, as the circumstances in which cooperation can take hold after everybody is a little bit less scared, then you have a government in charge now in the United States that may be in a role to play the sort of calm team leader, bringing people back together after the crisis. We're still in the depths of the crisis, obviously, and everybody is still completely freaked, and everybody is still racing to try and get an immediate advantage. But as things get better over the course of 2021, the opportunities to focus on the upside rather than just getting out of the immediate crisis and and escaping the immediate downsides might become more apparent. And I think that's when the payoffs from the Biden administration will start to come more apparent.
Gideon, help me here with the agenda of the president. The president's going to do a road trip, I assume, to Europe to, re-greet the allies, etc., meet the Queen or whatever. And then there has to be some kind of Asia swing. Is Beijing on the itinerary?
The details of that, certainly the China relationship, the Biden administration understands it needs to rebuild its alliances first, because the United States does not play international politics as an individual. It plays as a team leader. The Trump administration failed to recognize that. And the rest of the team was going, what's going on? Since 1945, you have been the leader of a global alliance that has essentially run the entire world. What are you talking about, this only America thing? The Biden administration, recognizing that it is team leader first and foremost, has made mending its relations with its core allies the first agenda item. But dealing with China and the U.S.-China relationship will clearly be the single greatest challenge over the course, not just of the Biden administration for American foreign policy, but for at least the next decade and maybe the next generation or two of American foreign policy. And so the question is, can the United States and China manage their relationship, which is clearly somewhat conflictual but does not need to go to war? Can they manage it with that and keep it within tracks and on rails?
Gideon, always great to catch up. Appreciate your time this morning, sir. Thank you. Gideon Rose there of CFR. I think there's another big question in the mix here, Tom, and it's whether Europe comes along with the United States. It's all well and good, the United States turning around and saying, we're back, we'll run the team again. It's been a failure of Europe to be on the same side when it comes to issues like China, like Russia, and to get the Germans to come along and the German government to come along on some of these issues has been really, really difficult.
And then the issue, John, is the calendar, in that we're going to get to the primary, the GOP primaries of November of 2022. And John, you're going to begin to hear the Republican isolationist rhetoric, and that's going to really diminish the trust that's needed forward. I mean, it's not a smooth process.
I completely agree, Tom, but I don't think we should be too critical of the United States without really thinking through what's going on in Europe right now. It is all well and good, the Europeans saying we need protection from Russia, but then you have to look at the energy relationship between Europe and Russia. It's all well and good to say we need to get on the same page about China. Look at the Europeans when it comes to China and the commercial relations between Germany and the world's second largest economy. These are complex issues. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures up 21 on the S&P. We advance 0.5%. Would you believe it? North of 39.50 already. From New York, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. The energy crisis crippling the Texas power system keeps spreading. Almost 5 million people across the U.S. have been plunged into darkness. Meanwhile, authorities are fighting to avoid a total collapse of the grid. Homes and businesses from North Dakota to Texas are losing power in the middle of an unprecedented deep freeze. Blackouts are likely to continue throughout today. Meanwhile, on Capitol Hill, Democrats are now turning their attention back to President Biden's priorities. They want to push through his $1.9 trillion stimulus package and get the rest of his cabinet confirmed. The president is unlikely to get everything he wants in the stimulus bill. At least 2 Democratic senators oppose the $15 federal minimum wage provision. And a surprise admission from New York Governor Andrew Cuomo. He says his government mishandled data from coronavirus-linked deaths in nursing homes. Cuomo admitted he did not answer questions about the total death toll from lawmakers or reporters. A Cuomo aide told lawmakers the state withheld data because it was afraid the Trump administration would use it to start a federal investigation. And Glencore has reinstated its dividend after posting record trading profits. The world's largest commodities trader is reporting its final results under the leadership of billionaire CEO Ivan Glassenberg. He's preparing to hand over control to the head of Glencore's coal business, Gary Nagel. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is under the radar.
This equity market's looking good.
You heard it first here on Surveillance.
The conversations you need to hear.
Always going to be fascinating here, particularly the view forward.
The business team you love to watch.
John, I would wrap into your lousy data check.
I've got to deal with you for the rest of this year.
This is what I do to keep you two apart.
Live from 6 to 9 a.m. starting February 16th on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I continue to think it's too soon to try to speculate about that. And again, until we see the path to getting past this virus, it will be difficult to make any prognosis about when that time might come.
We want
this lockdown to be the last. And we want progress to be cautious, but also irreversible. Next week, I'll be setting out a roadmap saying as much as we possibly can about the route to normality, even though some things are very uncertain.
We want this lockdown to be the last one. We all feel the same way. The Prime Minister, Boris Johnson, in the UK. From New York City this morning, good morning. Alongside Tom Keane and Lisa Bravis, I'm Jonathan Ferro, counting you down to the opening bell. And here it is, a break of 125 on a US 10-year. A move of 4 or 5 basis points on a 10-year. Yields higher, curve steeper. In the equity market, we keep rallying, up 22 points on the S&P 500, 339.50 and up 0.6%. And that has got to be the theme of this morning. Yields are higher, but it's not stopping it, this equity market rally, Tom.
It's really moving. And John, I would note the VIX goes the other way. The VIX is supposed to come in and go down with a better lift to the market. That is not occurring with the VIX up a stick, 21.00 off the good news that we saw on Friday. This is of acute focus for global Wall Street, the bet being made on volatility. We'll talk about that, I'm sure, all through this week. Right now on the deaths, the hospitalizations, the improvement in cases, Amish Adalja joins us right now with Johns Hopkins Center for Health Security and their senior scholar as well. Which numbers should we look at right now, Dr. Adalja? Which ones have the most transparency, the most view of how things are getting better?
The hospitalizations, that's something that is sort of binary. Either you're in the hospital or you're not. This is a number that's well tracked. It doesn't depend upon testing levels. It doesn't depend upon any kind of adjudication. So when you look at hospitalizations, I do think we're in a better place. The question is this sustainable? But I can see it in the numbers. I worked yesterday in the hospital. I can just tell by the pace and the cadence of the patients that there is something going on, and I think it's a good thing. And hopefully it continues this way and we don't get derailed and vaccination keeps up with the pace and we stay ahead of the variants, but it does look okay in the hospitals right now, better than it has for several months.
Doctor, relatively speaking, of course, I think we share that view. Good news starting to come out in the last couple of weeks. You mentioned the new variations, the new strains. How well are we tracking them in America right now?
Not very well. I think we really only do kind of a drop in the bucket or the tip of the iceberg. We just get a certain percentage of our tests are getting sequenced, so we really don't know what level of prevalence we have of any of these variants. So whatever numbers you look at on the CDC dashboard, we know that those are an underestimate, that they're not all getting tested. And we have likely more UK variant here than we've actually counted. So that's going to be the big if, is how much these spread and if they actually translate into more cases, more hospitalizations, and more deaths. And the goal, though, is to stay ahead of them with the vaccination rollout. And we have hit over 2 million vaccine doses a couple of days ago. So we are doing well in that standpoint, not well enough because it is basically a race to the end with this variant.
The race, this is what a lot of people have been talking about. Amish, how big is the risk that we lose this race and that the variants take over and there's a new wave, the vaccinations are not sufficient to really protect against these, and then there's a new variation that just builds on itself? I mean, how close are we to that cycle?
Well, the issue really is not about getting everybody vaccinated ahead of the UK variant. The UK variant is going to become dominant just by simple Darwinian laws. This is going to be the strain that most people contend with after some time. But the key is getting the vulnerable populations vaccinated, those people who get hospitalized, who get severe illness, or who die, because that's what this vaccine is about. It's not about making COVID go away. We're not getting to COVID zero. This is an efficiently spreading respiratory virus. It's about defanging it or taming it so that we never see it put hospitals into crisis. We never see it kill again. So if we can get our nursing home patients vaccinated, if we can get the community dwelling elderly vaccinated, then I think, yes, the new variant is here and it's causing cases, but it doesn't cause the same damage that we're dealing with now, with people dying from this in the thousands per day. That's the goal here, is to get to get this virus looking like the other coronaviruses that cause 25% of our common colds through vaccination.
A lot of people are saying that in some ways, this could have been so much worse had this coronavirus been more virulent, and this will not be the last pandemic. How close are we to having a vaccine that's easily adaptable to the new strains that come out, to potentially new variations of coronavirus that do emerge from a zoonotic transmission or elsewhere?
So the thing is that they used vaccine platform technologies, all of the companies, Moderna, Pfizer, AstraZeneca, Johnson & Johnson. That makes them very easy to plug and play. So you can update those vaccines against other coronaviruses pretty simply. And it's now something that we're already starting to do. The companies are starting to make these types of changes. It's unclear when they're going to need to deploy them or if we're going to need to deploy them, because the vaccines, even though they may have problems against certain variants like the 135 in South Africa, they're still able to prevent what matters, severe disease, hospitalization, and death. So I think we've got to make a kind of a policy decision. Is that good enough to be able to stop the severe consequences? Or are we trying to really decrease spread? And then if it's decreased spread, then I think you have to think about updating the vaccines. But if it's just the severe consequences, then I think we're in good shape with all of these vaccines.
Doctor, before we go, I'd just like to compare and contrast what's happening in the UK and the United States right now. We have access to the same vaccines, but we're using them differently. So here's the data from the US that we track. I'm sure you're familiar with it, of course. 11.9% of the population has had at least one shot, 4.5% fully vaccinated. You compare that to the UK, and it is really, really interesting. 22.9% have had one shot, and fewer than 1% of the population has been fully vaccinated. Doctor, do you have a view on the best way to use the doses available to you?
I do think that we need to get first doses into as many people as possible, and our second doses will come. I think the goal is to have our second doses occur on time, but if they come a little bit late, that's okay, because we know they're going to get protection. I think that the UK has a little bit of a difference because they are using other vaccines like the AstraZeneca, where there may be data about increasing the times between the two and doing mixing and matching. All of that needs to be data driven. I don't think we know exactly how to do it, but the goal I think should be to not wait for second doses, to get as many first doses into people and then make sure people get the second dose, but not having things stuck on a shelf waiting for people to come back for their second dose, but putting those into arms. I think that should be the primary goal, and let the manufacturing catch up.
Doctor, appreciate your time this morning. Important conversation. Thank you, sir. Dr. Amish Adalja of Johns Hopkins. Tom, I know this is something you've been following as well. It's a really interesting case study that's been developing in the UK, just to compare and contrast it with what the rest of the world is doing.
Yeah, long ago, John, this is what I did, and I'm going to go back to whooping cough, pertussis of the 1950s, and they had to figure out the booster regime through the 1990s, 30 and even 40 years after they figured out the vaccine to that horrific child illness. This is no different. What's so important here, John, is everybody's learning as we go. There's no certain rules here.
And we are heading in the right direction, Lisa. Your average now, the daily average per day in the last 7 days, 1.64 million in America.
And the question is, when can we start to get mass vaccinations where anyone can get it? We're still in a tiered system. And I will say the idea of what Dr. Amish Adalja was saying, the idea of just getting shots in people's arms, forget about exactly when they can get that second dose.
And as these vaccines roll out, this 10-year Treasury yield breaks out. Tom, 125 on a US 10-year, north of that level now.
Yeah, well, that's good. I'm in triple leveraged all cash, so I'm feeling comfortable. I'm not seeing price down right now.
Getting some income.
Thank you.
Go out further along the curve.
Safe.
Pick up 125 on a 10-year.
I think I need 60,000 before I put that first order in.
The second hour of Bloomberg Surveillance, the first hour on TV and radio just around the corner.
Home now?
Nope, 2 more hours. This is Bloomberg.
Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Now in the end of 2022, we could see the strongest GDP growth in over 50 years in the United States.
The economy could bounce back much faster than people anticipate.
We are just flooding the economy with both monetary and fiscal stimulus.
The point is to unleash consumption.
The hope is that we see this unleashed pent-up demand lift us even higher.
That April timeframe is perhaps when we will finally get that pullback a lot of people have been looking for.
The fact that money's going to get more expensive is a good thing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on Bloomberg TV and Radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. We have got to get right straight to this market. Equities, all-time highs, and your bond market goes from 124 to 125 to 126 on a U.S. 10-year yield.
And still counting, John, and what's important in the first hour of the simulcast is we had a bid on everything as well, a real risk on feel. Maybe it's not a melt-up, but, John, it is a melt-up going back to the election of Joe Biden. That November 6th date, for me, is important.
Capitulation. Look at the cash levels, Tom, in a fund manager survey from Bank of America this morning. 8-year lows. 8-year lows. Money being put to work.
Yeah, that's a real yield comes in as well. You and I are watching German, Switzerland 20 are now a positive yield. And John, you mentioned the Italian piece. I mean, in America now, we say so what to the Italian piece. Huge demand for that 10-year.
Record demand for a full chunky 50 basis points. Here's the price action this morning. Cross asset worldwide. Your equity market is climbing. Heading north, up 20 on the S&P. We advanced 0.5%. And Lisa, there it is. Yields up 5 basis points on the morning, with crude not doing a whole lot. 126, Lisa, on a 10-year.
Yeah, you've mentioned how this is interesting, that it is not affecting stock valuations, that stocks are continuing to climb despite higher yields. And it raises a question, what is the tipping point? Is there a tipping point? And does higher yields do that? Does a new regime of higher interest rates lead to a new regime for stock valuations,
If it's driven by inflation expectations, Lisa, does that drive you further into risk assets? Maybe that's the story this morning.
Well, maybe, but again, you were talking about this earlier with inflation. What's driving those inflation expectations right now?
Energy.
Is it simply oil? And is this a temporary disruption, or is this a longer-term phenomenon?
Let's turn to the energy story. Rachel Adams-Hurd joins us now, Bloomberg energy reporter out of Houston. Rachel, let's just start right there. Can you deliver the latest, please, on the crisis that is really developing over the last week or so?
Yeah, waking up this morning, it's striking to look out the window and see so much of Houston just in darkness. It was a really cold night for a lot of people. We're up to almost 5 million people across the U.S. without power. So this is clearly not just a Texas problem anymore. The whole grid just wasn't prepared for this type of winter storm event, and we're feeling it now.
When it comes to oil prices, when it comes to energy demand, what is the bigger driver of prices from here? The drop in supplies, as you have oil rigs that are going offline, where you have disruption in the supply of some of these energy production sources, or is it on the demand side where you see an increase as people try to heat their homes?
Well, that's the thing, is that we've never really seen it hit both sides of the market like this in the winter before. We're seeing all of the supply get shut in because the infrastructure in the Permian Basin, even these wind turbines, are not prepared to deal with this kind of cold. But then also, obviously, across the state and beyond Texas at this point, so many people are trying to keep warm. These rolling outages that we heard about over the weekend, they didn't work. The power went out for 30 minutes, and then, we expected it to come on 15 minutes later, but it remained out for 9, 10, 11 hours. And at this point, they're telling people that if you don't have power now, you might not have it for a pretty long time.
And for those of you on radio and our simulcast, extraordinary images of the Alamo. Be sure sometime today you find the time to see the snow in San Antonio. Rachel, I want to talk about what you and Brian K. Sullivan have written about, which is literally the pipelines, the infrastructure of our energy freezes over. Is it permanent damage, or is it just something that gets through until we get 20 degrees of warm up?
It is getting so cold to the point where there could be some permanent damage, but most of this is going to come back online pretty easily. The problem is that this isn't the Bakken oil field in North Dakota. The infrastructure isn't built to withstand these kinds of temperatures. So the assets that are out in the Permian Basin in West Texas, the pressure is dropping. They're having to shut in. The pipelines are declaring force majeure, and that's where we're seeing a lot of these barrels come offline.
Rachel, great to catch up. Appreciate your time this morning. Rachel Adams-Hurd there, down in Houston. Tom, I think that is the issue. Whether you think this and what we've seen play out in the last week will happen with more frequency in the years to come because of climate change, and whether the infrastructure investments that made no sense maybe 10, 20 years ago because it was protecting against the tail risk that may or may not develop, that calculation has shifted.
Yeah, it's shifted. At least, I mean, this is really, really important. And the grid, the way we've developed our grids is like one part of the country, and there's an entrepreneurial spirit of these growth economies like Arizona, like Texas, where they've sort of gone it themselves. Isn't that right, Lisa?
Yeah, well, basically, you can compete for pricing, for better pricing. It's like having a phone line.
Cheap.
You can switch your energy provider very quickly.
You can make Bitcoin.
Something like that, John. Pick it up.
Electricity was cheap. I think that's the story in Texas right now. Mandy Zhu joining us now on This Market from Credit Suisse, the chief equity derivative strategist. This market is grinding higher up, another 21 on the S&P, and we've got 126 on a US 10-year. Mandy, just walk me through your thinking right now, that relationship between the direction of 10-year yields and what happens with the broader equity market.
Yeah, hey, John. So I think we've gotten a lot of questions around inflation from investors in recent weeks, given the move in break-evens. And the point I make here is that it's important to differentiate like what we're talking about when it comes to inflation. Are we talking about a temporary overshoot of inflation this year due to reopening, due to all this, pent-up demand that everyone's talking about? Or are we talking about a sustained increase, sustained runaway inflation, right? I think the Fed really cares about latter. I think it doesn't really care about the former. And I have not heard anyone make a real credible case for the latter. And I think in this case, when it comes to inflation, it actually helps that Powell is not a trained economist or doesn't have a formal economics training like Yellen or Bernanke, because he's less wedded to economic theory that says, as unemployment comes down, inflation must rise, right? I think he's looking at the empirical data, which shows him that inflation is nowhere to be found in the developed world of the last 20 years. And as such, the Fed can be much more focused on its unemployment mandate without worrying about inflation. So what does that mean for markets? I think the Fed's going to be very, very patient this year. I think, even if we get a big core PCE, overshoot at some point this year due to reopening, the Fed's able to stay very patient, and that's positive for equities and positive for a lot of the rotation trades that we've already started to see that I think has further room to run.
Right. Mandy, help mere mortals here on a Tuesday morning with the Greeks. You're the derivatives ace at Credit Suisse, and the idea that you're moving up, you're in play, but there are signposts where enough is enough. What are the signals where you say in the derivative market, enough is enough?
Look, I think people are rightly worried about, I guess, the speed of the rally, how sustainable it is, or whether people are, investors are too complacent. So what I can say is, at least from the derivatives market, positioning at the index level is still very cautious. And I say this, with VIX still relatively elevated, even though markets making all-time highs. And I say it particularly if you look at, the demand for protection at the index level, that is still very, very robust. So measures of skew, measures of tail risk,
is the S&P, is still near the highs that we've seen over the past year. So at least in the index market, the flows that we've seen, we're still seeing a lot of demand for protection, a lot of downside hedges being put on. So I don't see that kind of euphoria that, at the index level that, I do at the single stock level, which is a totally different story. But I would say at the index level, positioning is still, fairly cautious.
Mandy, let's talk single stock. Let's talk GameStop and those hearings that Congress is going to be having later this week. What's your sense in terms of whether there was something improper that occurred with the derivatives trading that you saw that you think they will hone in on and perhaps target?
Look, I think the takeaway here is that this is much bigger than just one particular stock or, one particular segment. The bigger impact from, the retail trading that we've seen is that across broad swath of the market, we're seeing a complete repricing of upside risk. So, the GameStop, the AMCs, those are tiny, right? But within the S&P top 100 large cap stocks, right, 30%, over 30% of names are now trading with inverted call skew, which is just a technical term saying that the upside calls are now trading at a premium to the at-the-money calls. That is very, very unusual. To put that percentage in perspective, over the last 10 years, that percentage historically has averaged about 6%. Right, so now we're seeing over 30% of names trade with inverted skew, when traditionally it's been about 6%. I think that's the legacy, that's the impact from the retail option trading, where obviously the retail consumer base is typically buyers of upside call options, and that's why we're seeing this upside call risk being repriced higher across, not just small caps, not just the highly, shorted names, but we're seeing it, with the large cap tech names, with the financials, with the energy, across broad industries and sectors.
So, Mandy, we've got 30 seconds with you, so forgive me for pushing you on the time. You are much smarter than me. Put this into very simple terms for our audience this morning that might not be familiar with these themes. Yields are up, the equity market is up, and the VIX is up this morning. Why? Just in very simple terms, why is volatility up with the move we're seeing higher?
So I would say, the VIX is not just a measure of volatility, it also incorporates demand for puts and calls. So all else equal, if we're seeing more demand for upside calls, that could drive the VIX higher. That is one way in which the VIX can go higher as the market is going higher. It's driven by demand for those upside calls.
Mandy, thank you. I appreciate that. Mandy Su there of Credit Suisse. Tom, it's a really important theme to touch on because I think people over time get used to this inverse correlation between the direction of the VIX and broad risk assets, the equity market. Mandy's talking about something different that you need to get your hands around. Yields up, equities up, volatility up as well, the VIX up as well, to be more specific.
A lot of thinking about this over the weekend, some really good research notes here on the oddity of all this. And again, it comes down to speculation versus market moves that are more economic founded or investment founded. And this is going to play out. And there's some point, John, I don't know when the when is, but there's a when where the VIX breaks to 19 or 20, 18, lower VIX. And frankly, John, there's a big bet that's going to happen.
21 handle right now on the VIX at the moment, up 22 on the S&P 500, up 0.5%. And in the bond market, 126 on a US 10-year. We will turn to the energy crisis in the United States of America. We will speak to Jim Wright, Texas Railroad Commissioner, later this hour. From New York, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. An energy crisis has crippled the Texas power system, leaving 5 million people across the U.S. in the dark. Homes and businesses from the Dakotas to the Southwest have lost power in the midst of an unprecedented deep freeze. Grid managers can't say exactly when the blackouts will end. The cold blast is just the latest in a chain of extreme weather that has brought down power grids and upended energy markets globally. Meanwhile, House Speaker Nancy Pelosi wants to keep up the pressure over the attack on the Capitol now that Donald Trump's impeachment trial is over. She says Congress must create a September 11-type commission to investigate the assault. A number of Republican lawmakers say they'd support an investigation. Chancellor Angela Merkel wants to make a deal with the U.S. over that controversial Russian pipeline that will bring natural gas to Germany. It's been a particular source of transatlantic friction. Construction was halted for a year after the U.S. imposed sanctions. Merkel's coalition is working on a plan that would attempt to soften Russia's influence over Europe's energy market. And yet another record for Bitcoin. The world's largest cryptocurrency rose today, closing in on the 50,000 level. Bitcoin has risen fivefold over the past year. Still, there are warnings that investors could be left with big losses since cryptocurrencies remain highly speculative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
See an ad, when you use Ecosia and click on it, we make money. But now there's a big difference compared to other search engines. We use the money to plant trees all over the world where they are needed most.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Look at the journey we've been on with Microsoft 365. We started with individual tools, it became a collaboration suite, and now we think it's going to really get into a new space around employee experience, more holistically thinking about productivity.
The Trump movement is alive and well. People believe that he brought change to Washington. Policy-wise, it was long overdue. All I can say is that the most potent force in the Republican Party is President Trump. We need Trump plus.
There's no question, none, that President Trump is practically and morally responsible for provoking the events of the day.
Our Constitution and our country is more important than any one person. I voted to convict President Trump because he is guilty.
It is a party divided. Different messages coming from Republicans after the Trump impeachment proceedings. Senator Lindsey Graham there, of South Carolina, Senator Mitch McConnell, the minority leader, and Senator Bill Cassidy of Louisiana from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. We've got to touch on this market, not just the politics.
Yep.
Yields up, stocks up. 39.53 on the S&P. In the bond market, your yield on a 10-year, 126. Yields higher by 5 basis points. Yields higher. That curve is steeper, Tom.
John, pound sterling on the edge of a 140, 139.32 is stronger pound sterling. Why is that, John?
I think the story of the last month or so, Tom, the vaccine rollout has been really, really quite positive. Euro sterling, the other currency pair to watch too, and sterling's ripped back into form off the bottom of the last couple of months.
We're looking at some of the indices as well. John will cover those on the open. Look for that at 9 a.m. on Bloomberg Television while Paul Sweeney and I hold court on Bloomberg Radio. ADXY churning here. The Pacific Rim showing currency strength, sustained currency strength going back to the first of the year. Kevin Surley joins us again, our chief Washington correspondent. Kevin, the senator from South Carolina requests Trump Plus. How does the former president affect Trump Plus working out of Mar-a-Lago?
Well, look, I think we in the media overcomplicate this. Of what's former President Trump going to do? Is he going to rebuild? I mean,
what's he going to do?
There's a lot of logic. I mean, but it's fascinating to watch the media do this. Look, you've got 10 Republicans who voted for impeachment. Yes, the former president will likely primary those folks with some type of outside money movement PAC. You've got other potential races. There's some states that have been in the news recently where you could foresee some former top Trump agency officials running the former president could be a kingmaker. And yes, look, I mean, I've spoken with sources directly close to the former president over the weekend. And if you look at the issue of election integrity, he's not going to back down on that. I mean, Republicans can criticize the notion of what went down for how he wrongfully accused of being election invalidity without evidence. But the issue of election integrity at the state legislator level, I mean, we saw Stacey Abrams rise on the left. One could make the argument, as people close to the former president are, that there could be a counter effort on the right at the state legislator level.
Mr. Kudlow, I think, is going to wander over to Fox and launch today with a guest named Mnuchin. I get that, but does the former president does he go quieter over the next year if that's possible?
No.
Or do you see him
No. What
visible?
have you been watching for the past 4 years? That's not who he is. This is what I don't understand about why this obsession over trying to figure out what the moves are. He is going to continuously be who he has always been. And so absolutely not. He is not going to shy away. And he doesn't have the data yet to make the decision for whether or not he should run for re-election. The data points are going to come from all of those things that I just outlined.
Well, let's talk about some of the data points that might come ahead of the midterms. The title of Politico Playbook this morning that came out in the last hour, Republicans Can't Quit Trump. Walk me through the influence that he'll have, Kevin, on the midterms just a couple of years away.
Massive influence. And I think Leader McConnell is as a political astute statesman as they come. And if you subscribe to the notion, and I would respectfully disagree with the authors of Politico Playbook, if you subscribe to the notion that the Republican Party needs to be a big tent party, that includes suburban America. It also includes those rural communities that the Trump coalition was able to go for. And what you just struck on, Jonathan, was the difference between what Donald Trump does and where Trumpism populist politics goes. And those are two different things.
And Kevin, let's tie that into the idea of stimulus, the idea of infrastructure spending. What do these voters that are adhering to the Trumpism, the sort of populist feeling, believe in terms of what ought to be spent in order to get this economy back on track?
Well, this is where it gets interesting, and where Suzanne Clark, of the new president and CEO of the Chamber of Commerce, which she has an opportunity to really offer a seat at the table and a negotiating tactic from the chamber perspective to really get the Chamber of Commerce back on track here. Because, quite frankly, look, there are a lot of Republicans in rural communities who are not going to want to spend any more money, especially after a $1.9 trillion stimulus deal. And so when I look at this objectively, as a reporter, that's where the movement is going to come for the Republican Party on infrastructure. Because when you have 4 centrist Democrats down in Texas writing President Biden today or over the weekend and saying, please stop with this new Green New Deal stuff because we're getting pummeled with power outages and the coronavirus. I mean, that really is the exacerbated effort right now in the Democratic Party on the energy front that could take a lot of the political oxygen out of the room for Democrats when post 3 to 6 weeks from now after the stimulus passes, they want to talk infrastructure.
Kevin, as a generalization, have the Republicans lost the suburban vote, or is it easy 1, 2, 3 they can get it back?
I think you have to talk. I talk to strategists who argue that every time a party loses, it's the end of the party.
Exactly.
It's the obituary for the party. Wrong. We were talking about this with Democrats when Donald Trump beat Hillary Clinton. And so I look, if you subscribe to the notion, again, a big tent party, that means that the Republicans are going to have to, as Leader McConnell alluded to in his floor speech over the weekend, they're going to have to try to win back Republicans that backed and still believed in Trump, but then also try to make those inroads for the gig economy. I mean, look, the post, we talk about it every morning right here on Bloomberg Surveillance. The post-pandemic economy for a new generation of Americans is very different in terms of how people are earning incomes than it is. And I don't think there are enough policymakers who are in touch with that, quite honestly, on either side.
What will he do next? It's a joke, Kevin. Go on. Different person an hour ago. What happened to Kevin?
Well, I love this. Hey, was that a Tom Keene impression?
What happened?
People say it was the end of the party.
That's what it sounded like. Kevin, thank you, sir. Slightly caffeinated.
You.
Kevin Cirilli, down in Washington, D.C.
Slightly.
Host of Sound on Bloomberg Radio, weekdays at 5 p.m. Eastern. Tom, I'm disappointed. I thought I might get an invite to the Kudlow show. I haven't heard yet.
Yeah, well, we'll have to see.
Just to reverse the roles a little bit.
Yeah.
Just got to see how that works out. No?
That'll be
Don't
interesting.
fancy it?
Incredible drama.
Okay, let's get to this market. Let's get to this market.
Let's get to the market. Yeah, futures advance.
How about those markets?
Cable, 139.33. Sterling, Tom, approaching 140. Approaching 140, really interesting. Outside of that, yields up 5 basis points on a 10-year, 126. There we are. Struggled to break 120 last week. In fact, struggled to break 120 over the last several months, but we've got a clean break of that now. Yields are higher by 5 basis points. And Tom, equity markets are hanging in. Equity markets are drifting higher.
Come on, they're more than hanging in. They're more than hanging in. It's day after day after day.
39.52 on the S&P 500, up 0.5%. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City, this is Bloomberg Surveillance live on TV and radio for our audience worldwide. Here's the price action. This is what capitulation smells like in the Bank of America Fund Manager Survey. Sentiment on global growth, record highs. Cash levels, 8-year lows. V-shaped recovery, consensus. Futures push higher. On the S&P 500, we add some weight to the rally, up another 0.5% to 59.50 and change. And this is all happening as this happens. Switch up the board. Bond yields breaking out to post-pandemic highs on a 10-year, 126. Your yield right now, 125.51, and up by 4 or 5 basis points on a session. This is what we were looking for. Can the rally continue as treasuries continue to sell off? And so far, so good. Crude has been part of the story. WTI so far, year to date, up around about 20% plus. Crude up, inflation expectations higher, yields higher, financial conditions stay loose. Let's finish on this, switch up the board into the bond market. Talking about all the junk that's come to market over the last couple of months. It's getting sucked up, that's the story. Yield, spreads, can we get there? High yield spreads, can we show it? Tighter, tighter, tighter. There we go. And that's the story so far for the Federal Reserve. Financial conditions have stayed loose, even as Treasury yields have started to break out. And that's what you've got to keep a focus on for the Fed's next move, Tom. That's going to be the story. Will that continue? And will the Fed step in? And I would argue the Fed won't step in until you start to get tighter financial conditions that go along with that move in yields. And so far, you don't.
Well, you don't have it, but I'm noticing Bitcoin. I mean, I'm sorry, John, it is a melt-up. We'll get to Terry Weissman in a moment. I know Romaine has to do his ballet here, but Bitcoin above 50,000, John, who would have thunk?
It is part of the everything rally, and that continues so far this morning. Romaine, with the stocks on the move this morning. Hey, Romaine.
Hey, good morning, guys. We're going to go just back a couple steps here to that energy crisis, of course, which is still unfolding or still, I guess, persistent right now. Still more than 34 gigawatts offline right now in the central U.S. You are starting to see that actually affect some of the energy names and some of their prices there. Remember, you already had some demand momentum that had pushed these stocks higher heading out of last week. That's continuing into this week now because of the supply issues. But I just got off of a pretty long chat with a trader who really talked about this idea here that there's going to be some structural changes here, because obviously this goes beyond just barrels of oil or the amount of natural gas that's being produced out there. There are infrastructure issues here that can be resolved, and they could be resolved at the benefit of a lot of these publicly traded companies, not only in the oil space, but of course some of the electricity providers as well. You're already seeing the blame game take place here with a lot of states pointing the finger at other states, countries like Mexico pointing the finger at the U.S. It'll be interesting to see how all this gets resolved, but the reverberations from this, not just only in the electricity market, but what you're seeing on your screen there, this could play out here for the next few weeks. Let's flip up the board and go to my next board, which is not energy related. We can move on here from the natural gas production because we did get a lot of sort of traditional names moving this morning. Palantir earnings actually crossing the wire just a little bit while ago. There were pretty high expectations there. They did deliver on that revenue growth, 45% revenue growth. Here's the problem. This is a company trading at about 39 times sales. They gave a forecast for revenue that is about 30%. On top of that, they had a surprise loss on operating profit. So you're seeing the shares move down here. Keep in mind, the lockup expiration is just 3 days from now. That's not helping matters there. Coherent, unchanged here. But keep in mind that bidding war is now heating up. You have 3 companies right now bidding for this company. This is a laser maker, microelectronics maker. You have Lumentum, of course, made that bid last week for $5.9 billion. You had MKS had the original deal for $5.7. The latest deal now for $6.4. Coherent said, well, naturally, it's going to consider all offers and take the one that it sees best. IMAX, interesting story here. IMAX actually reported some really decent data coming out of China overnight. In fact, it was one of its best weekends that it had in China since the pandemic actually started here. So some optimism here, I should say, that once the COVID lockdowns are finally eased here, that there will be a lot of people back in the theaters, guys.
Romain, thanks for the brief. Sure. Looking forward to your work this afternoon as well. Romain Bostic, of course, the close. Right now, Terry Weissman joins us. Let's get right to it with futures up 20, Dow futures up 184. Dr. Weissman, I should say, with decades of work, ages ago at Bear Stearns, and now Macquarie Director of Global Currencies there. Terry, I want to talk about convexity, which is the idea of accelerative forces within markets. I see a little bit of convexity in Bitcoin. Forget about that. I see true convexity in the equity markets and acceleration that gets you to the language of melt up. Why are we getting convexity in the markets?
Look, the traders, I think, are getting increasingly optimistic about the prospect for a recovery finally coming with the copiousness of the vaccine rollouts and the improvement in the data with regard to new COVID cases that we're seeing in the U.S. We've also seen some toppishness in COVID cases in parts of Europe. I think this makes for good news with respect to the prospect of an earlier than anticipated recovery. The problem, however, is what might happen with the inflation front and whether rising bond yields will dampen any enthusiasm that we get that might be coming from a better cyclical outcome. I don't think that's right now. I think right now you can tell from survey data, from just polling traders and investors, the focus right now is still the cyclical recovery and not yet inflation. But inflation may for the markets down the road.
So, Terry, let's build on that and look at the bond market this morning. 2's out to 30s. Your 30-year yield through 2. Your 10-year yield briefly 126, right, just south of 125. What's the relationship that you expect to develop between the direction of yields and the US dollar this year?
Neutral, because interestingly enough, it's not just U.S. yields that are going to be rising. European yields, gilt yields, Bund yields, JGB yields will rise in tandem with U.S. yields. Let's face it, this is going to be a global recovery if it happens, for the simple reason that it was a global recession when it took place a year ago. If you believe that the recovery is predicated on the end of the pandemic and that the end is going to happen everywhere, ultimately, then yields are going to go up everywhere. And as a result, we may not see a strong dollar as a result of rising U.S. yield. You may in fact see a weaker dollar towards the middle of this year as other countries catch up to what the U.S. has done with regard to the amelioration and mitigation of the pandemic here in the States.
And Lisa, that's what you see this morning on a gilt curve as well. We're up 3, 4, 5 basis points in Bunds 2 over the last week. Same story.
Yeah, this idea that everyone is moving up in tandem. Here's what I'm struggling with, though, Terry, as we talk about inflation. When is it good inflation and when is it bad inflation and it actually threatens the cyclical recovery? I'm looking at a story right now in the Bloomberg terminal about food inflation, which has already reached 7-year highs in many cases and is poised to get even worse. I mean, how does that factor into the story when it's caused by supply chain disruptions and weather patterns, in addition to just increased demand?
Yeah, no, this is a great question. What is good inflation and bad inflation? I suppose a very simplistic answer here would be the kind of inflation that's good is the inflation that's associated with wider operating margins for the corporate sector in the U.S. and globally. In other words, if prices rise faster than costs, and they typically do at the beginning of a recovery, operating margins rise, earnings rise, profitability goes up, and the market likes that. However, there comes a point when costs start to rise too, because companies are competing with one another for scarce resources. And it's at that point that margins can start to come down. And it's at that point that we should worry about the implications of inflation, especially for operating margins and profitability.
Here's what I'm struggling with, Terry, as we talk about the rising inflation outlook and we talk about the cyclical recovery and the trade that, as John correctly said, is the whiff of capitulation to this bullish narrative. Is anyone pricing in an exit strategy for the Federal Reserve?
I don't think so. We were not surprised by this, by the way, but Jay Powell sounded extremely dovish last week. I mean, he was in full social justice warrior mode, seeming to suggest that even a compression in unemployment rates would not cause the Fed to take their foot off of the accelerator. I think there are other things right now that the Fed is watching besides just inflation and the broad U3 unemployment rate. Social equity is one of those things, and that seems to be one of those things that is biasing Fed policy towards more dovishness, not less dovishness. But having said all this, the market can move even if the Fed doesn't, right? Bond yields can rise, as we're seeing, even in the context of a dovish Fed, because the market may be longer term in orientation than the Fed itself is.
Terry, always great to catch up with you, sir. Terry Wiseman there of Macquarie. I want to finish on that line. Chairman Powell in social justice warrior mode.
I knew you'd pick up on that one.
I think it is so important, the change that is taking place at the Federal Reserve and the commitment they have to allowing this labour market to run hot. And ironically, doing that, Tom, will exacerbate wealth inequality in the minds of many people. Because what is happening in this market right now?
What's happening in the market right now, and forget about, all the rage and all that, I get that. John, we're at 9 million bodies unemployed. Now, that may rapidly come back. It may not. I don't know. But there's no debate about the labor economy right now. And every interview I do says we're not going to get tangible inflation until we get wage and benefit inflation.
We talked about the number of the speech last week. 10 million fewer people employed now than 12 months ago. 10% unemployment in the mind of Chairman Powell, a more accurate reflection of the labor market at the moment. But Tom, I think you can make the argument that Fed policy is being successful right now. Inflation expectations are higher. The yield curve is up because of that. And what's happening in broader financial conditions, they remain loose.
Donald Trump down in Mar-a-Lago would say it's been successful because the markets are up. I mean, you can take it any way you want. John, I would suggest this morning what we're seeing is not a deflation spiral. I mean,
no,
that was a theme last week, but we have aggressively shifted here with these yields at 125 away from worries about a deflation spiral.
Tom, you bring up the former president. Let's just sit there just for a second. If you were the former president watching this new Chairman Powell right now, wouldn't you be thinking, wondering, where was he a few years ago when this labour market arguably could have gone a bit further?
In the defense of all, including the former president, we had a natural disaster in the vicinity of the third week of February
Totally agree, Tom.
last year.
Totally agree. But you have to see that this chairman is a different man. And this chairman and this Federal Reserve is much more willing to allow this unemployment rate to go even further, even lower than they did in the last cycle, Tom.
Well, I don't know about the unemployment rate, but they're certainly willing to let the knock-on effects go, whether it's Matt Bessler's article and Ben Howland's article of a week ago or what we see in the Times today. This idea of overheating has just been blown aside.
And the market picks up on it, Lisa. Isn't that a story? Isn't that what's happening here? The market gets it.
For decades, inflation has not been an issue, and people have got inflation wrong. The big question is this time different, and could inflation pick up far beyond what people are expecting?
Bitcoin 50K, 10-year yield, 125 there and thereabouts, 39.50 on the S&P 500. The screen this morning, Tom, just lighting up, getting through some really interesting levels.
There's your inflation.
Yeah, and through levels. It is a reflation spiral. I mean, we can flip over what we did last week. I mean, there's no question about that. But, I mean, a 125, nobody thought. Ira Jersey publishing on it moments ago, John, on the idea of now at 125, what is next?
It is the 16th day of February, and we are through some year-end targets in a big way, let me tell you, across asset worldwide. From New York City this morning, good morning. This is Bloomberg Surveillance.
With the First Word News, I'm Karina Mitchell. The energy crisis crippling the Texas power system keeps spreading. Almost 5 million people across the U.S. have been plunged into darkness. Meanwhile, authorities are fighting to avoid the total collapse of the grid. Homes and businesses from North Dakota to Texas are losing power in the middle of an unprecedented deep freeze. Blackouts are likely to continue throughout today. Meanwhile, on Capitol Hill, Democrats are now turning their attention back to President Biden's priorities. They want to push through his $1.9 trillion stimulus package and get the rest of his cabinet confirmed. The president is unlikely to get everything he wants in the stimulus bill. At least 2 Democratic senators oppose the $15 federal minimum wage provision. And a surprise admission from New York Governor Andrew Cuomo. He says his government mishandled data from coronavirus-linked deaths in nursing homes. Cuomo admitted he did not answer questions about the total death toll from lawmakers or reporters. A Cuomo aide told lawmakers the state withheld data because it was afraid the Trump administration would use it to start a federal investigation. And Goldman Sachs is getting ready to offer its investing knowledge to the masses. According to Dow Jones, Goldman will unveil a low-cost digital platform called Marcus Invest. It will allocate and automatically rebalance individuals' wealth across portfolios of stocks and bonds. The minimum investment, $1,000. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. There is still much more to come. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
HSBC is very strong in Hong Kong and has been a very important part of our financial industry. So, of course, I would love to see a stronger presence of the bank in Hong Kong.
that so many people have been vaccinated, I think, to drive the numbers for us. I think it's really more an expectation that it will be possible in the coming months, and therefore they will be able to go places come this spring, summer, fall.
We hope so. That was Peter Kern, Expedia Group CEO from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here's the price action this Tuesday morning, shaping up as follows. Yields higher, equity markets higher, up 20 on the S&P. We add some weight to the benchmark, up another 0.5% in the bond market. A brief break of 126. Right now, 124 on a 10-year, up 3 basis points on a session. On a 30-year yield, still nicely through 2%. We are higher by 4 basis points on a 30-year. On 10s, Tom, up by about 3.
These are substantial moves, folks. We set up for Tuesday, and for an eventful week with a real lift, we've paused finally within our 3-hour simulcast, but nevertheless, as John says, up 24,000 beckons on S&P 500 out there somewhere. Mercedes Carnathon is with Northwestern University. She is in preventative medicine, which is the trenches of getting this pandemic done and finished. We're thrilled that Dr. Carnathon could join us, and particularly with endless feet of snow in the Chicago area. They are on the edge of that brutal cold. Mercedes, I guess the cold will hold down the vaccines from the Dakotas down to Texas as well. Is an opening question. How are we doing?
You know, thankfully, the pace of vaccinations has picked up markedly around the country. We're vaccinating 1.6 million people per day, which does exceed the targets that President Biden set. But the downside is that these vaccines are really hard to access. I imagine, you know, you've heard a great deal about the shortages and the long lines, and those are very concerning.
Well, the lines are there, but we've got to get it fixed. I mean, John has mentioned the United Kingdom model of a single shot. We're going more of a 2-shot sequence, the booster science that we know. What is your timeline here of the first signal of vaccination success? Is it within this February, or does it wait out into the early spring?
Well, I was really pleased to hear Dr. Fauci's prediction that April may be open season for vaccination. By then, the production of the 2-dose vaccines will be able to ramp up, and we'll hopefully very soon have the introduction of the new 1-shot vaccine, the Johnson & Johnson. You know, the model that the UK has used by offering as many people as possible the first dose to at least get some protection, you know, it certainly has its trade-offs, but at a certain point, it is not a bad strategy to try to get ahead and lower the risks somewhat. And I think we may be able to do that by this spring.
Mercedes, in the meantime, given the way that things have been rolled out, there are a number of doses that are being discarded at the end of the day because once they're defrosted, they cannot be refrozen and they must be thrown away. Is there a better way, perhaps giving doctors more discretion in terms of calling people on a list, getting them in, getting that vaccine actually to use rather than just throwing it in the garbage?
Oh, most certainly. And, you know, I've heard really exciting stories, such as the team that was caught in a snowstorm and they had vaccine and they went through and vaccinated people in cars. You know, that was it was a really exciting opportunity to see extra vaccine used. In certain areas, Facebook groups or other social media groups are forming that produce a list of extra vaccines at the end of the day. But the downside is all of these mechanisms for identifying where there are extra doses and rushing to get them advantage those individuals who are comfortable with social media, who are comfortable with digital platforms and can move on a dime. And that isn't going to do much to promote vaccine equity, which is a significant concern of ours right now.
Another concern has been getting kids back to school, getting them in the classrooms with their peers and giving their parents a chance to get back to work without that distraction. How close are we, Mercedes, to some sort of vaccination program for younger children, given the fact that we don't really have data yet on that?
You know, there are no data. And so right now, the presently approved vaccines are for children, older children and adults 16 and older. Right now, there are trials going on with the Pfizer vaccine. in younger children going down to age 12. But right now, the best way that we can protect our children when they return to school is for the adults in the situation to agree to vaccination. And so I know there's a lot of work being put into reducing vaccine hesitancy, especially among our essential workers.
Mercedes, fantastic to catch up with you this morning. Thanks for your time. Mercedes Carnathan of Northwestern University. This US-UK comparison keeps coming up again and again and again. And for those of you not familiar with the numbers, it is really interesting that the US has basically got to about 11.9% of the population has been given the first dose. And the two-dose regime, fully vaccinated, is at about 4.5%. You compare that to the UK, north of 20% has had one dose. Fewer than 1%, Tom, is fully vaccinated. That is quite a contrast.
It's a huge, no, it's more than quite. It's a huge contrast. And John, we are living a science experiment right now.
Totally. And the developing world, Lisa, has got to pick up on how this goes, because the developing world has hardly got started.
Well, and this talks to the idea of international travel and sort of the reglobalization of a world that's become increasingly fragmented and isolated. How do we get back to that kind of time? How do we get back to an economy that's actually going full throttle if we have such uneven vaccination schedules which continue, particularly in the developing world?
Couldn't agree more. At the moment, though, the United States, people looking at this economy confident in the back half of this year we can re-engage with the economy. And Tom Keane, this bond market gets it. Yields are up 4 or 5 basis points on 30s, on 10s, up another 4.
Well, yeah, but you worry about the worry. Doug Cass publishing a note moments ago, John, with the new extended duration we see out there from a 6-year level out to an 8-year level. That's not a small amount. That's a huge deal. And Cass being fairly gloomy here, unlike Lisa Abramowitz, is possible more gloomy. But Lisa,
totally on the same page there.
Yeah, Lisa, this is really serious. And that if you get yield up, price down, you get a bond loss.
Well, and this goes to a point that we were talking about earlier, and as John talks about bond spreads, the extra yield on corporate debt. At what point will that be insufficient to compensate for losses? Do we get to a tipping point where higher yields actually in the benchmark treasury leads to tighter financial conditions? We are not there yet, but there is a tipping point. We saw that in 2013, and when do we cross into that?
Well, Tom raises the really important point, though, about the increased rate sensitivity in parts of credit, Tom, because of that increase in duration. And high yield's been a great example of that. We've had these huge names drop from IG down to high yield, and they are typically longer in duration. We've also seen some of the high yield credits that have been there for a while issue long-dated debt as well. That average duration has been pushed out, Tom, in a big way, actually, over the last 12 months. That increased rate sensitivity, I think, is what you're talking about.
Well, it's a human condition here. You got to go out and get a yield, and we're all yield hogs at that. But, John, what it really does is it shows that we need to extend the real yield on Friday out to an hour, maybe out to a 2-hour show.
Have you heard the rumor?
Yeah.
That it will be extended out this Friday.
To 2 or 3 hours.
No, we'll go to 25 minutes first.
Oh, okay.
We'll get out from 5 to 25. Out from 5 to 25.
Reaching out.
Got to reach out to some guests as well, Tom, and organise that. So I'll do that over the next few days. From New York City this morning, good morning. Coming up, James Bevan, CCLA, the Chief Investment Officer on this equity market, out to new all-time highs, up 20 on the S&P, 39.51, up another 0.5%. And in the bond market, yields higher, up 4 basis points, 124, call it 125 on 10s. Your 30-year through 2% last Monday, comfortably through that level now, up another 4 basis points.
就是我们看中它的那个品牌吧，它品牌就是说东西比较干净嘛，然后比较方便的话，味道也还可以的话，我觉得我会考虑吧。外卖的话呢，也是一种方式，就是品种会多一点嘛，各有它的特点吧。
这个车的话，目前我们是通过这个手机 APP 上，就手机扫码，然后微信和这个支付宝扫我们这个车上的这个二维码，大家就会进入到一个小程序的这个界面，然后呢就可以选购自己喜欢的商品，然后付款之后呢，这个柜门会自动打开。
支付成功，请拉开右侧车门取货，并关紧柜门。
然后我们会取餐，然后完了之后呢，就把餐这个柜门关上，然后整个购买的这个流程就会结束。
柜门已打开，请取出货物并关好柜门。
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is under the radar.
This equity market's looking good.
You heard it first here on Surveillance.
The conversations you need to hear.
Always going to be fascinating here, particularly the view forward.
The business team you love to watch.
John, I would wrap into your lousy data check.
I've got to deal with you for the rest of this year.
This is what I do to keep you two apart.
Live from 6 to 9 a.m. starting February 16th on Bloomberg Television.
The cyclical elements will almost certainly show some uptick.
Between now and the end of 2022, we could see the strongest GDP growth in over 50 years in the United States.
We are just flooding the economy with both monetary and fiscal stimulus.
The point is to unleash consumption.
The hope is that we see this unleashed pent-up demand lift us even higher.
That April timeframe is perhaps when we will finally get that pullback a lot of people have been looking for.
We're still in the depths of the crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast on Bloomberg Radio, Bloomberg Television. Thank you for joining us. Just an extraordinary market day. And John, we can talk about futures up or sterling to 140, but basically in the yield business, it's yield up, price down, and we're beginning to see some real price effects.
We broke 2% on the 30-year yield last Monday, Tom. It was becoming increasingly difficult to break 120 on a 10-year, then bang, we did it, then bang, we broke 125. Yields are higher, and I think the story that we've been beating on over the last couple of weeks is that yields are pushing higher and financial conditions have stayed loose, and they stay loose this morning.
Yeah, and again, of course, folks, there can never be a bear market in the bond business. Apple, what is it, 10 days ago, 15 days ago, John, does that piece out, I think it was 20, 40 years, it's down 4%, 4.2% in price. That's one of the effects you see.
Look, Tom, you're much better at bond math than me, but pull up the century bond out of Austria. That is brutal. Right. Brutal.
Lisa bought that for her kids. This is a bond out 100 years in Austria. And Lisa, the price is down 25%, but who cares about that? I'm looking at the safety of that yield.
Yeah, my kids are calling me up saying, I thought that this was supposed to be fixed income. What happened to those losses? Talking about losses and your point earlier, Tom, about what that means for longer term bonds and how volatile they can actually be in terms of total returns. And bonds in the U.S. maturing in 15 or more years years have lost more than 6% so far this year. They are poised for the worst start to the year since 2009. To give you some perspective, when people see that in their portfolios, do they rotate out of those instruments, and what does that do to yield?
Rotating with a vengeance here, Lisa, into the equity markets. John, S&P 4,000. We're not to 32,000. Chad on Dow. BitDog up to 50,000 a print a bit ago. John, it is a reflation.
Tom, it's unreal in the equity market. 3,800, that was the call from Bank of America. 3,850, that was the call from Wells Fargo. 3,900, that was the call from Morgan Stanley. 3,950 is where we are right now. Now, look, it's still early in the year. It's the middle of February, and all of these strategists that had these calls back in the back end of last year, Tom, they sounded bullish at the time, and they stick to their view that that's where we should finish at the end of the year. At least that's their forecast. But you really do smell a capitulation in the last couple of weeks, don't you? You really, really do.
You see a capitulation this morning, folks, and I do want to suggest the anomaly here of the VIX, which was an important reading piece over the three-day President's holiday. The VIX is supposed to be 19. Or 18, or John, dare I say 15, and this is a VIX that just will not come in. John, the VIX at 21.02, what does that signal?
And that's what I find really interesting, and Mandy Zhu touched on it a little bit earlier. This is not just about volatility, Tom. This is about demand for upside protection. This is about bullish calls as well, and that's why I think on a morning like this morning, and we saw this story at the back end of summer last year as well, you can get the VIX higher, 21 handle, and you can get the equity market charging higher as well.
Some of the mix that we see there, and we've had a wonderful eclectic set of gifts across 3 hours. Today, Alan Ruskin of Deutsche Bank joining us. I thought Terry Weissman was really good with Macquarie. Right now, on the simple idea of staying in the market, James Bevan joins us with CCLA in London. And what is so wonderful about Mr. Bevan is the idea of placing capital and monitoring managements. James Bevan, how easy is it right now to place new capital for long-term investment?
Tom, I think it is relatively straightforward. I am much more bullish than the strategists and forecasters that you have spoken to. I am anticipating that the S&P 500 can achieve 4,300 points in the current year and 4,800 points by the end of next year. I get to those numbers because I believe the forward earnings of the S&P 500 by the end of this year will be at $190 and over 200 by end 2022. And on that basis, I am expecting to have to pay 22.5 times earnings to reach my 4,300 target for the index. And I think that is sustainable because I believe that we are going to have this very rare cocktail of fiscal policy that remains supportive of economic growth and central bankers keen to keep liquidity flowing. So I do not think that the bond yield will rise out of hand. I completely concur with the perspective that real yields are way too low, the nominal yields are being suppressed, but I liken it to the period 1942 to 1951, when, as we know, the Federal Reserve kept a lid on bond yields, allowed inflation to begin to accelerate, and it was fine.
I mean, John, this is really important. 1942 to 1951, that was the last time Tottenham won.
It's been that long, Tom. It's been that long. 4,300. There's a number for you, James. What a number. That's the Goldman year-end call. 4,300 on the S&P 500. Where's the leadership come from? Because, James, I know you. You won't be just buying the index. Where's the leadership come from that gets us to 4,300?
Well, I am looking for the solid earnings growth because in the back of my mind is the very real concern. Do we actually have a significant melt-up rather than a steady progression? And I would look at the progress of the indices since last March, quite similar to what happened after the collapse of long-term capital management in 1998 and the run-up to the peak of the NASDAQ in March 2000. Now, on that basis, we're only halfway through a major surge and melt-up. And I worry that if we get a significant melt-up over the summer, then the fourth quarter of this year is going to be really testing. So I have had to lag a fast-rising market to focus on quality earnings growth. For me, that's speaking to the best names in technology, the Alphabets and the Amazons. It's the healthcare companies like Medtronic and Stryker. And it's also thinking about the global branded goods companies, which I still believe will be too cheap in the context of long-term earnings growth progression.
James, just got to cut in with some breaking news. Just very quickly, sir, forgive me for 30 seconds. Southwest Grid ordering rolling blackouts for a second consecutive day, just to keep you up to speed at home on the deepening energy crisis in the United States. Tom, that headline just crossed on the Bloomberg. The Southwest Grid ordering rolling blackouts for a second consecutive day.
Yeah, it's back and forth. This is the power pool of moving the electricity out, and it's just overwhelmed. Usually it's a hugely, John, air conditioning, summer cooling grid, and this is something new for them to see this profound cold.
James, let's talk to the thematic theme around all of this, the thematic investing around all of this. There will be calls about infrastructure investment in ways that there weren't in the previous few decades, in places that typically you wouldn't have to have those discussions. Texas. There will be a conversation about dependency on renewables as well, and increased dependency too, James. From an investment perspective, how do you approach that?
Oh, I absolutely believe that the Biden agenda is going to light the blue touch paper on far more infrastructure expenditure and on renewables, the recommitment to the Paris Agreement, and as we know, the COP this year is in Glasgow, and we will be expecting a move from suggestions as to what strategies would be helpful to hard targets for individual countries. I think that will accelerate the spend on renewable energy, but also energy efficiency. So I would view these as great areas for long-term investors to be able to make sensible returns.
And James, you certainly have seen a lot of money flood into these areas. All of this cash and the fact that we're talking about these targets, 4,800 by next year, raises a question that if zero rate policies have rendered boom and bust bubble models absolutely obsolete, what do you look for to serve as a warning sign that perhaps it's time to sort of rethink the thesis?
Well, to me, the single biggest factor is going to be inflation, because I think it is inflation that will ultimately drive the shift in monetary and fiscal policy. I looked at the US CPI report last week, and interestingly, although there is plenty of supply chain inflation, it has yet to surface at the CPI level. I would reasonably anticipate that Mr. Biden and Mr. Powell will both be wary of accelerating inflation, because inflation is regressive. It harms people at the bottom of the wealth scale far more than those at the top, and therefore higher inflation absolutely jars with the Biden-Powell agenda of fairness to all people. So certainly a rising inflation profile showing up in an acceleration in bond yields. In the UK, were we to see 10-year yields get back up to 3%, that would be a 30% loss. We are, as you've already identified, seeing shifts up in yields in the States. I think that we would see a correction, but not a bear market, if we were to begin to see 10-year bond yields getting to 2%, not far from where we are now.
Well, 3% in the UK would be something. 10-year gilts right now, 60 basis points, James. James, great to catch up, sir. Always great to talk.
Great to speak to you.
James Bevan of CCLA, bullish, looking for 4,300 year-end. Just to familiarise you all with where we are on year-end calls, when I looked at them last, the middle of December, and went through them all, this is where we were at. Bank of America, 3,800. Morgan Stanley, 3,900. Barclays, 4,000. JP Morgan, the most bullish, Tom, at 4,400. Goldman, 4,300. Look, we've got bullish very quickly. We've had a huge, huge move off the back end of October, and we keep adding some weight to it, Tom.
Do you extrapolate out single digit, and then what is the band you put around it? And I really don't know the game, John, with how fast
Tom,
we've moved.
I'm laughing, but if you'd asked me that question at the end of last year, I would have laughed at you and said, don't be ridiculous. Don't extrapolate out the performance of the last 3 months through the rest of this year.
But
and
that's
then
what
the
we're
small
doing.
cap move just continued, Tom. The Russell's up another 15, 16%, and we add some more weight to it through 21.
And Lisa, it's also the banks as well. I mean, it's not just the leadership, if you will, or small caps of stories. Things that were dog of dogs have really rallied.
In some ways, this is the capitulation to a landscape where you have a Federal Reserve that's going to tamp down yields for the foreseeable future, and you have a Biden administration. Well, says the market and says the Federal Reserve, and this is sort of the real tension. Will the market, will inflation threaten that thesis?
You know what the ultimate sell signal might be? When Lisa capitulates. Are we there yet? Are we? No.
To capitulating to what? Contrarianism?
No, just capitulating to the
Not
bullish
being
view of this
gloomy?
market. Yeah, just coming on and saying, you know what, things look great.
There is a difference between being bullish and trying to look around corners at what could possibly counter the narrative.
You tell him. You tell him. Coming up, Texas Railroad Commissioner Jim Wright joining us
out of this.
from New York. This is Bloomberg.
With the first word news, I'm Karina Mitchell. An energy crisis has crippled the Texas power system, leaving 5 million people across the U.S. in the dark. Homes and businesses from the Dakotas to the southwest have lost power in the midst of an unprecedented deep freeze. Grid managers can't say exactly when the blackouts will end. The cold blast is just the latest in a chain of extreme weather that has brought down power grids and upended energy markets globally. In other news, House Speaker Nancy Pelosi wants to keep up the pressure over the attack on the Capitol now that Donald Trump's impeachment trial is over. She says Congress must create a September 11th type commission to investigate the assault. A number of Republican lawmakers say they'd support an investigation. Chancellor Angela Merkel wants to make a deal with the U.S. over that controversial Russian pipeline that will bring natural gas to Germany. It's been a particular source of transatlantic friction. Construction was halted for a year after the U.S. imposed sanctions. Merkel's coalition is working on a plan that would attempt to soften Russia's influence over Europe's energy market. And yet another record for Bitcoin. The world's largest cryptocurrency rose today, going over 50,000 for the first time. Bitcoin has risen fivefold over the past year. Still, there are warnings that investors could be left with big losses since cryptocurrencies remain highly speculative. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. There is much more to come. Stay with us. This is Bloomberg.
the change. After Giuseppe Conte's government, I think it's time to give the country in the very good hands. Mario Draghi is the best man to be prime minister. He saved the euro, he will save Italy.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Every part of the state will be getting either snow or ice.
I want to encourage people to stay home, to stay off the road.
Obviously, it's generating demand that rivals almost what we see in the summers. Extraordinary demands on the system for winter in Texas.
1 million homes and businesses out of the 2.6 million total served by CenterPoint in our region are out due to state ERCOT outages. In some ways, we're still close to the beginning of the incident.
Leaders in Texas urging its millions of residents to stay home and stay safe as the winter storm leaves many in blackouts across the state. From New York City this morning, good morning to all. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro, live on Bloomberg TV and radio. This is Bloomberg Surveillance. Let's just touch on a price action quickly before we turn to an important conversation. Equities are higher, yields are higher too, up by 3 or 4 basis points on 10s. We did have a little look at 126 earlier in the session on 10s. 124.34 is where we are right now. And to round things out in the equity market, Tom, up about 4 or 5/10%. Let's call it 39.50 on the S&P 500.
John Farrow, thank you so much. Again, futures up 18. We're watching that closely. There is a crisis from, call it, Winnipeg in the normal winter of Canada on down through the Dakotas into Texas. We've seen the snow at the Alamo. It is a freeze. It is, in many cases, a blizzard with massive hardship. We tried to go out and find the guy qualified, and yes, that would be the Railroad Commission of Texas Commissioner Jim Wright, but not for the reasons that you think. Jim Wright grew up west of Corpus Christi. He's a legitimate guy who knows about the animals of Texas, the rodeo, bull riding, and all. He has a visceral knowledge of what people are putting up with right now. Jim, we want to talk to you about the electric grid and the rest of it, the energy markets, but I've got to ask you this morning, you're living it. Tell us what the ranchers are doing across the southern Midwest.
Well, I can tell you from being a rancher myself, we've been out repairing pipes. So we make sure that we have water and energy to our livestock and water to our homes.
Is there a risk here, or with modern technology, is it going to be different than 1949 or 1889?
I don't see it being much different right now from those times. You know, pipes seem to break whenever it gets cold, and you still have to go out and fix those.
Well, Jim, given the fact that extreme temperature may become something more normal or perhaps more regularly occurring going forward, what do you expect to be necessary to fortify the electricity grid as we know it?
You know, I think that we're going to have to take a stronger look at who's allowed priority on our grid system. Right now, we're saying that the renewable energy has that priority, which is discouraging our reliable energy source, which seems to be more natural gas, fossil fuel related, from coming in and building the plants needed to pick up this power demand in times like these.
Wait, I just really want to clarify this, Jim. Are you saying that the problem here lies with the wind turbines and some of the renewable energies and not with some of the pipelines and freezing and other issues there? Is that what you're saying?
Well, yeah, in a certain way. You know, I think that as we here in Texas have said that renewable energy has priority on our grid, we've discouraged people coming in and building power plants that run off of natural gas, which is more of a reliable source than as everyone knows, wind and sun is. So I think that what we're experiencing today is the fact that we just don't have enough plants to keep up with our demand during times like these.
What does the Railroad Commission of Texas need to do to dovetail a boom economy and the capitalism of Texas with the constraints, the limits that you face ecologically?
You know, I think that one of those big things is more along the lines of educating people on the benefits of fossil fuel and the benefits of our renewable energy. You know, both have places here in Texas. I think that we need to make sure that we are smart enough to make those coexist and alongside one another, but while still keeping a focus on improving our environment. You know, when I look at the environment, I look at that in two ways. It's not only what mankind's impact is to our planet Earth, but it's also the impact caused by the debt that we're accumulating, trying to continue to protect what mankind's impact we seem to think we have on Earth. You know, we've had some large issues here in Texas with flaring, and I think it's important that we in Texas start developing more of a market for our natural gas, so that continues to be a good, reliable source and does not create any type of impact on as far as emissions is concerned.
Jim Wright, you've got a crisis right now in this weather. The crisis was your stunning victory a year ago within this important position for the state of Texas. How did you pull that off? How did a rancher from basically west of Corpus Christi pull off the victory you pulled off, and how can you provide that lesson as leadership to move Texas forward?
You know, I think it shows that people in Texas are looking at people they're putting in office today to be more of a leader with a business mind. You know, I've been in business pretty much all of my life with my own companies, and worked closely in the oil and gas industry and all energy sectors. And the people that are out in that sector seem to dominate what we have here in Texas, especially in the rural areas, and they know what that means to our economy. And I think that's the key to success is people that know boots on the ground and how to get issues resolved.
Jim, it's fantastic to have you on the program with us, sir. Please come back soon. Stay close, and we wish the state well. Jim Wright there, the Texas Railroad Commissioner. Tom, this conversation is going to be ongoing now. The increased dependency on renewable fuels and whether that introduces some fragility into respective grids. But we should rely on the numbers, the data. This comes from Will Wade and the team here at Bloomberg News. Wind only comprises 25% of the state's energy mix at this time of the year. So what we've seen take place, the majority overnight outages were plants fueled by natural gas, coal, and nuclear. And two-thirds of power generation, that's two-thirds of power generation during this winter season, Tom. So it's important to recognize that and try and stick to the data, because this conversation is going to build up in a very, very political way in the months to come.
It's going to build up. And Lisa, what's so important here, you were in the boom Dakota economy years ago with energy as well. Everybody wants that growth that Mr. Wright sees in Texas, but how do you do it with some form of new energy template? And that is one of the great debates of the Biden era.
Yeah, there also is a debate, though, and we didn't touch on this, but sort of a more piecemeal approach to the grid. The idea that you aren't paying electricity companies to have capacity in surge times. That is actually a feature of Texas. They do not do that, unlike places in the Northeast, which is part of the issue, Tom, that has driven there to be a little bit less continuity here, as some of those pipes that actually have oil going through them have frozen over.
More to come on this deepening energy crisis in the United States. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Coming up, Lewis Alexander, Nomura chief U.S. economist. On this market, as bond yields start to break out and your equity market does not break down, we are mounting up once again, up 18 points at the S&P 500. We advance 0.5% with yields almost at 126 on a 10-year, up 4 basis points on a session. This is Bloomberg.
Animals across the globe are dying by alarming rates. A report by World Wildlife Fund and the Zoological Society of London found that populations of mammals, birds, amphibians, reptiles, and fish fell by 68% in the last 50 years. In the tropical Americas, the rate was worse, with a 94% decline in the same period, and the size of observed wildlife populations in or near freshwater globally have fallen by 84%. Continued human abuse of the planet may lead to the collapse of the systems and resources that allow global civilization to persist in the first place. Overfishing and hunting, invasive species, pollution, habitat loss, and climate change are the main causes of this animal population crash. The report compiles evidence from 4,392 different vertebrate species and concludes the evidence for humanity's destruction of biodiversity is unequivocal. Using powerful computer models to simulate policy that stops biodiversity loss, scientists have explored scenarios to slow the trend. Such measures would include expanded conservation, increasing agricultural yields while also eliminating food waste, and cutting the global meat intake in half. By changing what the world eats and how it produces that food, nations could stop this tragic loss of life by almost 50%.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. What a move we've had. Remember those headlines in early November about the efficacy rates of these vaccines? Bang, up 20% since then. Unreal since the back end of October. We had some weight to the story, up another 0.5% on the S&P 500, 39.50. That's the year-end forecast of Deutsche Bank, 39.50. Look, by definition, the forecast cannot be wrong. It is a forecast, and we are not year-end, but just gives you an idea of how bullish things have got and how bullish things have got quickly. Switch up the board into the bond market. Equities all-time highs, yields post-pandemic highs. You get the picture. Stocks can move higher with yields. Credit Suisse, the team, Jonathan Golub, etc. They've written about that in the last week. They think you can continue to get that move, and that's what we see this morning. Your 10-year yield through 125 at 125.18, up by 4 basis points. Your 30-year through 5 basis points, north of 2%. We saw that last Monday. We'll see it this Tuesday morning. Finish on this in foreign exchange. If yields are being driven higher by inflation expectations, what does that mean for the dollar? Weaker, stronger. At the moment, weaker. Euro dollar back to a 121 handle, 121.33, and just about positive on the session. We've seen some dollar weakness so far this morning. Kind of ebbs away, Tom, in the last hour or so.
Yeah, well said. That's right where I was going to go with DXY, the blended big trading index, 90.34. Make it 90.40 on DXY. It's fractionally weaker, but I'm noticing euro stronger against yen as well. Let's get right to it on the economics of the moment. Louis Alexander joins us with Nomura to recalibrate where our central bank is. Lou, you know the line. You learned it freshman year. When the facts change, I change. So said Maynard Keynes. How does a central bank change their communication when their perceived facts change? What should we expect from the Powell Fed?
Look, eventually when they have greater confidence about the outlook, I think they're going to indicate that they're going to have an active discussion about tapering, that's going to happen in the foreseeable future, and that ultimately they're going to be raising rates. But I think Powell's been pretty clear since the last FOMC meeting that they think it's too early to have that conversation. So we're going to get the minutes of the January meeting this week. We're going to have a bunch of additional Fed speak. I don't think we're really going to learn very much because I think they think it's too early to have that to make that change.
The one statistic which we look at, Lou, as I'm sure you do at Nomura, the high frequency statistic of claims. Where do claims at 800,000 have to migrate back to what we knew of 220,000? Do we need to get all the way back there? Is that a legitimate gauge of potential Fed action?
Look, claims are an important indicator, but I don't think that benchmark at getting back to pre-COVID levels is the right way to think about it. One of the things that's just been remarkable about the last year is you've had obviously very bad outcomes in labor markets in terms of employment, but you've also had substantial gross hiring. You've had an incredible level of churn in this economy. Obviously, there have been areas like high tech, in the distribution sector that have been growing jobs quite dramatically. And so that very high level of claims in an environment where employment is rising is an indication of just how dynamic the economy is right now. And so I suspect you're going to continue to see employment increase. Claims will trend lower, but I don't think you should think of it as like until we get claims back down to the 250,000 a week level that's normal. Like you're gonna I think see a heightened level of gross turnover in this market.
Lou, just how frank for us, how much has changed at the Fed in the last couple of years? We had a lot of tongue-in-cheek conversation about Chairman Powell and how much he's changed and become a social warrior, so to speak, in the minds of some people that have come on this program. How do you frame that change that's taken place at the Fed in the last couple of years?
So I think it is remarkable when you think about what the Fed was worried about in the 80s in terms of trying not to do too much to support labor markets and focusing only on inflation. They have essentially come back to where the policy debate was in the 1960s. The fact that you had Powell referencing the 1946 Act that essentially embraced full employment is pretty remarkable. You've had Lael Brainerd talk about the definition for full employment is everyone who wants a job has a job. That is a remarkable transition. Now, I think it's consistent with an economy where inflation remains very low. Like the notion that somehow that's going to create an unwanted inflation problem, I don't think the evidence is there. So I think it is perfectly reasonable for the Fed to have sort of moved in that direction.
Although there is a question of what they can actually do at this point. They've kept monetary conditions incredibly easy. Any company that wants to borrow, at least in public markets, seemingly can for a legitimate rate based on what we're seeing with junk bond issuance. Will this help the 10 million people who are out of work now versus February 2020 get back to work, or will they not necessarily have jobs because of this rapid transformation due to the technological advancements and sort of the acceleration and ongoing trends that we've seen since the pandemic?
The Fed is doing what it can do. You're absolutely right that the Fed can't actually give people jobs. And the tools that the Fed have affect the macroeconomy in general, whereas the problems we face are much more narrowly focused. That's why Fed officials have focused on fiscal policy as the better tool to address these problems. And I think that's still the right way to think about it. But what the Fed can do is not get in the way of that recovery, and that's clearly what they're intent on doing.
There's a question, though, that is the Fed giving a sort of out to Congress to not take action, to not pass certain fiscal plans, because people look at the stock market and they say, everything's just fine. I mean, at what point does the Fed's stimulus, does the Fed's effort end up hampering the recovery on a longer-term trajectory?
Look, I don't think the Fed can think of this as three-dimensional chess vis-a-vis Congress. They've got certain tools. They've been given a mandate. They need to exercise those. And I think they've got to leave it to others to make those political decisions about how to use other tools for policy that they don't control. I think it would be a mistake for the Fed to try and think through it in that kind of complicated way.
Lou, what's the exogenous shock you worry about? There's something that's out there that we always never see. Within the pantheon of greater macroeconomics, what's the exogenous shock you're considering?
So look, obviously there's still a lot of uncertainty around the pandemic itself. Obviously, if there were to be new constraints. You talked earlier about the effectiveness of the vaccines. If that were to be called in question, that's obviously sort of a crucial thing. I think you worry a little bit about geopolitics. Obviously, the world's a complicated place. The relationships with China, whatnot, are, complicated and whatnot. And look, that aspect of the world continues to be a difficult one. I'm not particularly worried about upside risks on inflation. The market is so focused on that, I think that's not the thing I'm particularly worried about.
What about the other side, downside risk to inflation?
I think it's still there, particularly if we don't get the strong recovery that we're all expecting. I have a pretty robust forecast for the next year, but if I'm wrong on that, there are downside risks to inflation. The remarkable thing actually about the last two cycles, though, has been the fact that inflation didn't really fall that much over the last year, and it didn't really fall that much a decade ago in the global financial crisis. So while I think one can be worried about that, one could be worried too much about it. Inflation isn't just the center of what I'm worried about at this point.
We've got to leave it there. Thanks for being with us this morning. Thank you very much. Lou Alexander of Nomura. Sometimes you have to deliver some very upsetting news, and on behalf of Marriott, we have to do that this morning. Marriott International announcing that the CEO has unexpectedly passed away. This, of course, is Mr. Sorensen. We, of course, anyone familiar with his life, especially over the last couple of years, diagnosed with pancreatic cancer back in 2019, Tom, and more recently stepping back from the work schedule so he can undergo some more demanding treatment. And we have to announce this morning that he has passed away, and he passed away on February 15th.
He was fragile a year ago when we saw him at Davos. It was really a shock for me and John to get through that interview, and he had the courage to stand. John, what I will always remember about this guy was there was clear a genuine feel for how they floated on 144,000 employees. He was visceral about the labor management relationship as he brought Marriott into the modern age.
Just to give you also a sense, talking about bringing Marriott into the modern era, he was the first chief executive officer not to have Marriott in his name, to not be part of this family. And he took the company through a very difficult time. Now Marriott has to have a new leader through a time of incredible change, given the backdrop, John, that we've been seeing with respect to travel and vacations.
Yeah, a great man, very kind, and always enjoyed the conversations we had with him, Tom. And it didn't matter how much you pushed him either. He'd always sort of brush away the questions with a smile, and afterwards he'd shake your hand. And that, of course, is not typical of some CEOs, let me tell you that, because when you push some CEOs, they don't want to play that game, and afterwards they'll walk away straight away. He wasn't one of those.
He'd come off the deck and say, by the way, where are you guys staying in Zurich? And we'd say, well, Motel 6, of course.
A great man.
A great man.
With great sadness, we have to announce that Arne Sorensen of Marriott International, the CEO, died on February 15th. Coming up on this program, on the Open, a little bit later, JP Morgan Chase head of U.S. equity strategy, Monica DeCenso. Looking forward to that conversation a little bit later this morning. Got to touch on the price action as well, guys. Please. Just briefly, your equity market, all-time highs on the S&P 500.
Again.
We have some weight to it. Yields through 126 briefly this morning at 125.68. Yields are higher by about 5 basis points. And just a little bit of dollar weakness briefly. Then it snaps back. Euro dollar now negative to 121.16. But certainly the theme of the last week has been yields going higher, financial conditions staying loose. And that's something to keep an eye on in the weeks and months to come.
Yeah, and yields, Lisa, yields pegged up here. I mean, what's IG high yield done with this pullback in sovereign?
Yeah, well, that's the thing. It's been fine. It's been totally steady because of that extra yield that has continued to shrink, that extra cushion of yield. At what point does that flip? And that's what a lot of people will be watching, John.
Yeah, much more still to cover through the week. Looking forward to doing that with you. Alongside Tom Keene and Lisa Abravitz, I'm Jonathan Ferro. I'll be stepping away to count you down to the opening bout on Bloomberg Television with equity futures positive, 14 points on the S&P, up around about 1/3%. But the story is a breakout in Treasury yields, a breakout, and still we hang tough for the equity market. And as Tom points out, it's much bigger than that. It's not just a mild move higher. It's been a monster move higher since the back end of October. 20% plus gains on the S&P 500 in the last, 3.5 months? Unreal. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Karina Mitchell. The energy crisis crippling the Texas power system keeps spreading. Almost 5 million people across the U.S. have been plunged into darkness. Meanwhile, authorities are fighting to avoid a total collapse of the grid. Homes and businesses from North Dakota to Texas are losing power in the middle of an unprecedented deep freeze. Blackouts will continue throughout today. Meanwhile, on Capitol Hill, Democrats are now turning their attention back to President Biden's priorities. They want to push through his $1.9 trillion stimulus package and get the rest of his cabinet confirmed. The president is unlikely to get everything he wants in the stimulus bill. At least 2 Democratic senators oppose the $15 federal minimum wage provision. Coronavirus cases and hospitalizations are dropping dramatically across the U.S. That suggests that measures to stop transmission are working, at least for now. Almost 28 million Americans have tested positive. That probably gives them some degree of immunity, and almost 12% have received at least 1 dose of a vaccine. Plus, data gathered from mobile phones suggests people are being more cautious day to day. Goldman Sachs is getting ready to offer its investing knowledge to the masses. According to Dow Jones, Goldman will unveil a low-cost digital platform called Marcus Invest. It will allocate and automatically rebalance individuals' wealth across portfolios of stocks and bonds. The minimum investment, $1,000. And yet another record for Bitcoin, the world's largest cryptocurrency, rose today, going over 50,000 for the first time. Bitcoin has risen 5-fold over the past year. Still, there are warnings that investors could be left with big losses since cryptocurrencies remain highly speculative. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Michael Henry there of BHP on the state of commodities. And of course, commodities lifting up here, and we see that this morning. Oil, this is West Texas Intermediate, the lower price, 59.64. Brent crude, 63.03. A headline just coming out here, which is symbolic maybe of the moment. Sometimes it doesn't work out. Adidas will begin the divestiture of Reebok. That has been expected, but now is more than official by Adidas. They begin the divestiture process of Reebok. Right now, Barry Ritholtz with Lisa Abramowitz and Tom Keene here on radio, on television. Barry, I just said, what if? That not, the third week of August of 07, we're not all that smart, but somewhere in the vicinity of September of 2007, I made the idea to get out of the markets. The getting back in is so darn hard. And now we see it with an SPX up 10% over that broad 13-year period. That's real money. There's a cost there of never been able to get back into the market. How does Barry Ritholtz do the getting back part?
So I have the exact opposite view from you. Getting out of the market is the challenge because, as we've seen time and again, we craft these wonderful narratives about how things are frothy and toppy and the market is peaked and valuations are terrible. And that was 1996, and you had another 4 years and a few 100% in gains. So it's much more challenging to pick a top. To me, bottoms are obvious. They're easy. It's when everybody is terrified and when you see capitulation. Bottoms are easy to spot, harder to act on. Tops are easy to see a false top and much easier to act on.
Barry, tell me about catharsis or capitulation, the emotion at the top. Do you observe it now?
We definitely see pockets of froth, whether it's GameStop or Bitcoin or Tesla, or just generally stretched valuations. But all of those things come with a massive caveat. And whenever that caveat is, whenever we see comparisons to past historical valuation frameworks, it's never with 0% interest rate, never with a massive quantitative easing, and never with a multi-trillion-dollar fiscal stimulus. And so risk assets have become very attractive, and risk-free assets are not showing a whole lot of potential for gains. And so that TINA trade, that there is no alternative trade, seems to be having some sort of an impact. I think that's a little too cute of a definition, but massive fiscal and monetary stimulus tends to send markets further, longer, and higher than anybody expects.
There's a theory out there that eventually the Federal Reserve will have to tighten policy, potentially in response to inflation. I see you're laughing. And this is the question. What happens? Markets right now are not pricing in any sort of tightening cycle, even as they price in increased inflation going forward. Could there be an exit strategy, or does the Fed have to keep zero interest rate policies, or else risk disrupting this entire market valuation model that we currently have?
So break tightening into two phases. The first phase is just normalization. Hey, what is historically a normal interest rate? Where should bond yields be? Where should the Fed funds rate be? You want to call that 2, 2.5%, 3%, pick a number, it doesn't matter. That can be effectuated gradually over time, especially if the Fed gives lots and lots of notice that, hey, lower for longer is now lower for shorter and not so low. The more challenging part is going to be one day, off in the future, theoretically, we'll see inflation start to rise. I think Wall Street economists are wildly mistiming that. It isn't imminent. There's so much slack in the labor market. Even with a rush of pent-up demand, there'll be some transitory inflation. The bigger question is what happens in 24, 25, 26 when you start to see more systemic inflation working its way in? Will the Fed have the courage of its conviction to go from zero to normal, and then from normal to tightening where they're legitimately using rates to restrict inflation? And that's still years off.
Well, it's years off, and yet people have long-term portfolios that they're trying to arrange and manage right now. I know you talk with them, Barry. I mean, what do you recommend? They stay away from 60-40 because of this conundrum that the Fed faces later on? Or do you say, you know what, that model has worked, stick with it, we don't know anything better?
Well, you know, you don't have to be married to 60-40, and given where yields are, you could look more at 70-30. On the ultra high end, on the high net worth, you could look at things like structured notes if you're looking for yield. And if you're in the right state, municipal bonds and in a taxable account certainly can make up some of the yield issues. Keep in mind, the key purpose of a 60-40, yes, yield and coupons are important, but the volatility dampening, the ballast to offset your tendency to panic, and as Tom said, move to all cash. You know, the triple levered cash portfolio is not appropriate for people in their 30s or 40s. They just have too long of an investment horizon. But when a market's down 40% and you're all equity, you're down 40%. And a lot of people simply can't live with that.
Hold on a second. Barry, are you endorsing Tom Keene's triple levered cash portfolio?
No.
Are you telling him this is the right thing for him right now?
So the optimal portfolio is not the one that generates the highest return. It's the one that you can live with, not wake up in the middle of the night feeling like you need to throw up and then liquidating the next day and missing. Think about how many people never got back into the market after 08, 09. Yep. And we were getting emails 2011, 2012, 2013. Hey, I panicked out in 2008. And when you went back in 09, I thought you were crazy. I need help. I'm in Tom Keene's triple all cash ETF. It's much more challenging to ride out an all equity portfolio than having a 70-30 or an 80-20 or something that means that when you see the S&P down 40%, you're not down 40%.
No, we got to leave it there. Barry, thank you so much. I got 8 other things to talk about. We will consider that into this week with Barry Ritholtz, of course, of Bloomberg Opinion. Lisa, really, to me, a seismic shift day. This is not a normal beginning of the week.
No, because you're getting those record highs, but you're also getting a significant move in benchmark yields, a significant move in the expectation of inflation, and frankly, the everything rally very much hitting commodities. And there are different drivers of everything, Tom, but it's leading to this belief that the reflation trade can lead to a happy ending where you end up with just a soft landing and everything just moves on after the pandemic.
And that's wonderful as well. Thanks to Rob Carolyn, particularly for his work short notice on the cold across the Midwest. Stay warm out there. Ken Wallace, the CEO and founder of Ken Wallace. That'll be on in the 10 o'clock hour this morning. Please stay with us on radio and television through the day. This is Bloomberg.
Focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle. themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops. Infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it, stay on schedule if it's a bus, or avoid other vehicles, avoid accidents, provide information about weather conditions, potential hazards down the road, and so forth.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I continue to think it's too soon to try to speculate about that. And again, until we see the path to getting past this virus, it will be difficult to make any prognosis about when that time might come.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with equity futures positive 12 points. We're up a third of 1%. Let's get straight to it. We begin with the big issue. Bond yields breaking out, equities at all-time highs.
Everything is going up.
The bigger issue is what the market does and what the bond market does.
The 10-year Treasury is rising.
I think it comes down to what the pace of the move is.
The yield is rising rather quickly.
I've never seen anything like this at all.
This reflation trade, is historic.
Bond yields will be a help.
We are definitely positive on equities relative to bond markets.
There's good reasons to be bearish in terms of bonds.
That's an easy statement to make.
The bond yields rising is positive for the equity markets.
We don't really know, how to appropriately value things.
A lot of liquidity sloshing around.
Fiscal and monetary stimulus.
A bit carpet bombing kind of approach.
The freight train that few institutional investors want to get in front of right now.
The Fed clearly doesn't want to take away the punch bowl.
We can continue to get this everything rallying some more.
Financial conditions are as easy as we've ever had.
Conditions are as easy as we've ever had. Alan Ruskin at the end there. Let's bring in the Bloomberg team. Bloomberg's Abigail Doolittle and Katie Lyons. Morning, Abigail.
Good morning, John. And perhaps it has everything to do with the fact that financial conditions are as easy as we've ever had, that the risk rally just continues. If we start off with stocks, we're going to see that U.S. futures higher for another up day, another day set for all-time highs right on the open. Europe slightly down at this moment, earlier higher. The Nikkei had a very solid session, up 1.3%. And interesting that all world index down ever so slightly right now. But if it can turn back higher, John, up 12 days in a row for its longest winning streak, perhaps since 2003. Let's see whether or not the gains will continue. Now, when we turn to commodities, another segment of the risk rally, we will see, another one turning down ever so slightly. Crude oil had been above $60 per barrel. Of course, in the cold weather, the freeze drove oil to its highest level since 2018. Let's see whether or not it can get back into the green. But their natural gas up 7.3%, soaring. And copper, very importantly, up 0.8%. And then to tie it all together to the monetary stimulus, the fiscal stimulus, and the vaccine vaccine optimism. Over the last 6 months, John, we have both the S&P 500 and the Bloomberg Commodity Index climbing up about 17%. If we took this chart back 5 years, it would not be the case. The Bloomberg Commodity Index would be down to flat, the S&P 500 up more than 100%. So that reflation rally really hitting commodities along with stocks, John.
Commodities up, stocks up. Abigail, thank you. And all of this is happening with a 10-year yield at 125. On global fixed income, here's Kaylee.
Yeah, John, and everything rally except in the bond market. All those reflation expectations Abigail was just talking about, hopes of stimulus boosting growth of inflation, higher commodity prices also boosting inflation expectations mean a sell-off in bonds resulting in higher yields, especially at the longer end of the curve. The 10-year Treasury up 4 basis points this morning to 1.25%. That is the highest since February of last year. Same goes for the 30-year yield, which right now is sitting around 2.05%, 40 basis points higher than where it started the year. And with that underperformance of longer maturities, we have seen a dramatic bear steepening as well, John. The closely watched part of that curve, the spread between 5 and 30-year treasuries, has widened to 154 basis points. That is the steepest level in 6 years, since all the way back in October of 2015. Now, that steeper curve and higher yields helping out some areas of the equity market, bank stocks being one, but at some point they could become problematic. Savita Subramanian over at Bank of America has said that for investors looking for income, higher yields could put TINA at risk, that there is no alternative, quote unquote, theory pulling people away potentially from buying stocks. According to her research, only 62% of stocks within the S&P 500 have dividend yields above the 10-year Treasury yield. Only 44% of them yield more than 1.75%, which is Bank of America's year-end focus or forecast for the 10-year. To this point, the equity market continues to rally on, looking through higher yields, but that may not last forever, John.
Kelly Lyons, thank you. I think Savita raises the right question. At what point does this move in yield start to compete for capital elsewhere? Worth pointing out that Bank of America's year-end call on the S&P 500 is 3,800, together with Citi, with SocGen as well. Wells were at 3,850. Morgan Stanley were at 3,900. Deutsche Bank, 3,950. Where are we right now? 3,950 on February 16th. We'll talk about this a little bit later in the program. The Bank of America Fund Manager Survey, which is getting a ton of attention for some good reasons and some arguably not so good reasons this morning. Here's the bottom line. The bottom line, the only reason to be bearish is ... There is no reason to be bearish. Capitulation, the scent of capitulation this morning in this. The Fund Manager Survey sentiment on global growth, record highs, V-shaped recovery, finally consensus, and cash being put to work. Cash levels at 8-year lows. Can this continue? Can Treasury yields keep going high? Can the equity market come with it? This is to take a tool back as Michael Purvis saying earnings are helping to fuel the rally. Quote, earnings expectations are buffering the impact from rising bond yields. Valuations are in a different place as long as the Treasury sell-off is a risk-on sell-off, which this one continues to be. Michael Purvis, great to catch up with you, sir. Let's start right there. I think one thing that we've glossed over in the last couple of months, last couple of weeks that we should not have is that earnings growth year-on-year, positive. Revenues growth year-on-year, positive. Positive. That is positive, Mike.
It is, certainly, so we're seeing the 10-year yields, 30-year yields and so forth, climb higher, but you also have to kind of map that the trajectory of earnings growth is also mapping higher. But look, there's no question that, the relative valuation argument, the earnings yield, less the 10-year Treasury yield, for example, that was a core part of my bullish calls throughout last year. That spread is now getting tighter and tighter, and that puts all the more pressure on that earnings growth to continue to accelerate. There, when you tie that plus with the sentiment that you were just referring to, the low cash levels and this, bullish sentiment, there's no question that we are entering, a trickier time where you have to be, what I would call sort of a neurotic bull. Like you have to be bullish, but you also have to be very careful and watching it. In the rally leading up to COVID over the last several years, it was, consistently one of the most hated rallies, right? You had to learn to love the hate. Now everyone seems to be loving this rally, and perhaps a little bit too much. So you need to be in it, but you need to be very careful and look for those sort of pivot points at the same time.
We'll go through the signposts then, Mike. What are you looking for?
Well, it's interesting. One key thing, I think, and this is sort of a backdrop, macro foundational issue to this whole risk rally here, is that the bond yield, the Treasury yields have been climbing, But what's not climbing is Treasury volatility. So if you look at the MOVE index, which is like a VIX for the Treasury curve, that's ignored the blue wave. It's ignored this, rise in break-even inflation rates. It's ignored, this huge rally across commodities and so forth. It's as if none of this has ever happened, right? It's still stuck in this extraordinarily low sort of post-Fed pivot last year low levels. If that starts really climbing up, that's one factor I'm looking towards, where this Treasury sell-off is going to be not a risk-on sell-off. The other factor I'm really looking to is sort of like what I try to do is deconstruct the 10-year Treasury yield. And what I see is when I look at the money market futures, they are steepening in the 2022, 23, 24 timeframe. And as that steepness is transmitted directly, almost basis point for basis point, into the rise in the 10-year Treasury yield, if I start seeing sort of an added fear premium or some sort of U.S. credit premium, if you will, being factored in on top of that, so yields are going up even more than what's being priced in money markets, then I think we're going to get into a different place. But so far, that's not happening. So we have a very constructive Treasury sell-off where the markets are like, yes, I get it, but we're not seeing a strategic change from the Fed, nor are we seeing some sort of like credit premium being applied to treasuries because we're having, record deficits.
Well, Mike, let me jump in. It's arguably because it's been driven by inflation expectations. If it was driven by real rates, we'd have a different conversation, wouldn't we?
Yeah, no, that's right. And I think that's part of the, macro backdrop is that real interest rates here are still remarkably low. They're likely to stay remarkably low there. And that does two things. One, it reinforces the bid for risk assets simply because real rates are low, but also it puts that downward pressure on the dollar. And you have to remember that when the dollar is weakening, it is loosening economic conditions, not just in the United States, but also in China, which are the two pillars of global growth.
And Mike, so that's going to be the bite point for the Fed. That point right there will be the bite point for the Fed. If financial conditions are loose as yields rise, great. If they start to tighten, not so great. I want to wrap up with this. It's important. So we're trying to look at the relationship between Treasury yields and the broader equity market, the risk asset universe. I want to finish on this point, Mike, the relationship between the VIX and broader risk assets as well. I think typically people think it's more intuitive to see an inverse correlation between the VIX and broader risk assets, the direction of the S&P 500. We've got a VIX up a point, 21 handle, as the S&P 500 continues to rally. Can you just briefly, in simple terms, Mike, explain that relationship?
Well, yeah, you're absolutely right. VIX typically, it goes up when equities go down and so forth. One of the things about it is that, and I think you were referencing Mandy Zhu earlier, that, and I completely agree that it's supported partly by this big call buying you're seeing. That's supporting the VIX as well. That's sort of a bullish tell. But I think, on the fear side of the VIX, the fact that we walked into 2021 with an elevated VIX, it actually gives space for, it's actually a risk-on supportive thing. And I would suggest that in many instances throughout the past 9 months, the risk-on rally has been a not as complacent as it looks kind of rally, partly because of this elevated VIX. So there's plenty of room for the VIX to contract. It's contracting at a very measured lower pace. Part of that's because of call buying. Part of that's also because the options markets are worried, but that worry is a wall that can be climbed by the equity market.
Mike, good to see you. You're looking well. Michael Purvis there of Toolback, and on the latest in this market. Equity futures fading a little bit, 39.43 on the S&P, still positive 12 points. We're up a third of 1%. Big outperformance from the small caps. We'll discuss that around the opening bell. With your movers, here's Abby.
John, and a piece of that small cap outperformance also has to do with reflation around banks and energy. If we take a look at what's happening for the big cap banks, we're going to see nice gains there, and that has everything to do with yield yields backing up, as you and Michael were just talking about. JP Morgan, Citigroup, both up much more than 1%, but it extends to the energy complex as well, even though oil is just about even right now. Take a look at ExxonMobil and Occidental Petroleum. Both of these names are higher, of course, as we have some of these refiners on hold right now. That could really flow to the bottom line, and you see these energy names higher. Turning to the Bitcoin complex, lots of gains there too. Not surprisingly, with Bitcoin earlier above $50,000 for the first time ever, an important psychological mark. So Riot Blockchain, MicroStrategy, and Marathon Patent, that rally, that speculation, it continues, but backed by the asset. And then finally, John, one weak spot, Palantir, the data mining company, they reported they put up a surprise loss in the quarter. Investors clearly not liking that. Palantir Technologies down 6.2% in the pre-market, John.
Abby, thank you. Coming up, the energy crisis deepening across the country in the United States. Joining us, a conversation coming up shortly with Ellen Wald of the Atlantic Council from New York City this morning. Good morning to you all. After a long weekend stateside, the opening bell 17 minutes away. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We are going to lose 10 to 12 million barrels of gasoline quite easily, and about 7 to 8 million barrels of diesel. What this does do is put us up for a very strong summer, even before demand's picked up. So it's bullish for Brent because refining margins are going to pick up.
Energy aspects, I'm Rita Sen weighing in on emerging U.S. energy crisis. Crude prices topping $60 a barrel briefly, with freezing temperatures crippling much of the nation's power system and shutting some of the country's biggest refineries as well. On the latest, it's Kaylee.
Yeah, John, this big freeze is having a large impact. A second day now of rolling blackouts being instituted, affecting customers across more than 14 U.S. states. About 5 million people experiencing power outages in these frigid temperatures. This extends well beyond Texas. It's as far as Virginia and Oregon. Even in Mexico, the power shortages have triggered cascading failures that have affected 4.7 million homes and businesses. It's also affecting energy demand, of course, and production. Half of Texas's wind power capacity has been forced offline because of ice on turbines. And when it comes to oil, wells getting shut in the Permian Basin, resulting in a drop of U.S. oil production by as much as 1.7 million barrels a day. Some of the largest oil refineries have had to shut altogether. Energy Aspects is estimating barrels of daily oil processing capacity has been idled, about 3 million of them. And natural gas production has also been curtailed. 10 billion cubic feet of gas production shut right as cold caused demand to jump. That has led to a big boost in natural gas prices and oil prices, as we're looking at here up more than 20% on the year. WTI topping $60 earlier in the session. Natural gas futures right now up about 8% on the day. And you can see the frenzy not just in the benchmark prices, but in options activity as well. Trading of WTI call options, so bullish bets on crude, hit a record on the Intercontinental Exchange on Friday. More than 80,000 call contracts trading. A lot of the volume in trades that would profit from an oil rally toward $100 a barrel. And I would note, John, you can buy these calls on Robinhood. So there does beg a question, how much of this is Reddit and retail investors acting in crude right now? Because we know that they have been all in on this bullish speculative frenzy, John.
Kelly, thank you. More from Kelly Lyons later in the hour. Ellen Wald of the Atlantic Council debating whether the US should prioritize improving infrastructure or alternative power sources, saying the following, quote, "These questions will become more pressing as we rely more on electricity. If our mobility is dependent on the grid and not on gasoline or natural gas, mobility will become less reliable." Ellen joins us now for more. Ellen, there are two themes here, and they're related, but just initially I'd like to keep them separate. There is the weatherization approach about the investment in infrastructure we need in places like Texas, and then there is the dependency on other fuels, away from fossil fuels. Let's just start with the first piece. It used to be a decision as to whether to make this investment based on how economical it would be. Base case, this was a tail risk. Do you want to protect against it? How has that decision changed in the last 10 years, Ellen?
Yeah, well, exactly. I mean, what we're seeing in Texas is really a result of the fact that Texas isn't meant for this kind of cold, and it's not necessarily the fault of wind power. The issue is a lot of this has to do with natural gas plants and other plants that just aren't weatherized for this kind of cold. Things start to freeze, they shut down. And the question is, do we want to invest in the kind of infrastructure that can withstand this cold in a place like Texas? I mean, we know we can do it. We have power plants all over the United States. They have wind turbines in Wyoming. They drill for oil in Siberia. So all of this is possible. The question is it worth the sunk cost to do that for an event that's really only going to happen maybe every 50 or 60 years?
So there are two questions that you follow up to that with, Ellen. One is whether that event that we used to think only happens every 50 years happens with more frequency. And two, even if it doesn't happen with more frequency, if mobility is increasingly dependent on the grid, whether we have to protect against the tail risk anyway.
Exactly. I mean, this is terrible for the people who are experiencing it, and we need to ask ourselves: do we want 100% reliability from our power grid, or are we okay with some disruptions? And if we're going to move more and more towards electric vehicles, making our mobility dependent on the grid, then we need to ask these questions and say maybe it's worth it to reinforce the grid itself, the transformers, to reinforce the power plants and things, if we're going to be making our mobility more dependent on our electricity supply.
And whether we should make that electricity supply more dependent on renewable sources. Ellen, you've heard that question asked repeatedly in the last week. What's your analysis of what has gone wrong and what's gone right in the last few days?
Well, I think what really has gone wrong is just it's too cold for too long, and the equipment wasn't really made for this. The fact that Texas has a lot of wind power, they weren't really expecting to get a lot of wind power in the winter anyway. So yes, a lot of the windmills are frozen. Yes, we could have protected against this, but that's not necessarily the problem. On the other hand, perhaps we need to invest more in things like nuclear power. Not a lot of nuclear power has gone offline. I've heard reports that some has, but perhaps that $70 billion that was spent on wind power might have been better allocated to nuclear power if we're dealing with a world where we've got a finite amount of resources to expend, on our power grid and our electricity generating supply. So I think these are the kinds of questions we need to ask. What's actually the best use of the money available to provide the most reliable sources of electricity?
You and I have asked a lot of questions in the last couple of minutes, Ellen. Let's finish on an answer. What's the policy prescription you would like to see pursued in Texas and beyond?
I'd like to see them pursue a policy really of a real mix of energy and not too dependent on any one source. I think it is important that we invest in all different types of electricity, and wind power has done fantastic things in Texas, but we have to remember that that's not the only source of power, and it's not 100% reliable, and we really do need to have a very broad mix of power generating sources.
Is there something unique about the Texas market, Ellen, that's complicated things?
Well, one of the things that's unique is that the grid manager is managed in Texas and not managed federally. So that is somewhat different. Texas is a very large state, but we are seeing these issues all over the place. We've seen similar issues in Florida. We've seen similar issues in New England. They're all a bit different, but they all come down to the same thing, which is what is our priority for keeping the lights on and the heat on, or the air conditioning on, to people in situations of extreme weather.
Ellen, stay close. Let's continue this conversation over the next couple of weeks. Ellen Wald there of the Atlantic Council. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, global equities matching their longest winning streak in 17 years. That conversation just around the corner with JP Morgan's Monica DiCenso. From New York City this morning, good morning. About 7.5 minutes away from the opening bell in New York. Equity futures positive, let's call it 12 points on the S&P 500. The Nasdaq up 1/3%. The Russell is where the stellar outperformance has been. Year to date, what are we up now? 16%? Unreal. From New York, this is Bloomberg.
To be an action that was either illegal or caused disruption. But this was really political satire, kind of writ large, and it was all about actually trying to get to the man himself and make him see how we see him. And in order to do that, we knew it had to be big and it had to be colourful and it had to be somewhere where everybody could see it. It's important because we didn't just do this for attention. This was actually about making a serious point, which is that the majority of people in this country do reject the politics that Donald Trump represents.
Look at the journey we've been on with Microsoft 365. We started with individual tools, it became a collaboration suite, and now we think it's going to really get into a new space around employee experience, more holistically thinking about productivity.
5 minutes out from the opening bell in New York City, the focus still down in Washington, D.C. on a monster stimulus program. $1.9 trillion of stimulus could be coming from the government at some point in the next several months. Your equity market gets a lift, up by 13 points on the S&P 500, up 1/3%, 3943.50. The conversation, reflation. How inflationary will that stimulus package be? Look out for the price pressure at the factory gate. PPI in the United States comes out tomorrow, I believe. We also get retail sales as well. So a really interesting slate of economic data coming up tomorrow morning at 8:30 Eastern time. You can expect, of course, full coverage on this program through the next 24 hours and beyond. Let's turn to some morning calls, shall we? A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Loot Capital, upgrading Alphabet to a buy, a 25.25 price target. The analyst expecting momentum in online advertising to continue through the year. Your second call comes from Argus, upgrading Mattel to a buy, a $22 price target. The analyst expecting content partnerships with major studios to boost demand for its toys and products. And your third and final call from Baird, downgrading American Express to neutral, a 126 price target. The analyst forecasting muted earnings growth due to the ongoing impact of the pandemic. Three of the calls behind us. Up next, the opening bell. Coming up, unprecedented risk-taking prompting calls of complacency once again on Wall Street. That conversation just around the corner with JP Morgan's Monica DeCenso. From New York City, this is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It is a global equity market absolutely unleashed. Up 19 points on a Russell, up 0.8%. Last week on the Russell, up 2.5%. Year to date on the Russell, up 16%. 20% gain since the end of October on the S&P 500. Just unreal, up another 0.25%, 39.41. And the Nasdaq up 30, up 0.2%. That's the opening bell. Switch up the board, get to the bond market. Yields can go higher as equities go higher. That's been the lesson of the last couple of weeks. We've learned that lesson before, haven't we? Up 5 or 6 basis points on a 10-year, 126 on a 10-year. After struggling to break 120 for much of last week, a clean break now. 126 on 10s through 2 on 30s. In the FX market, euro rolling over in the last hour. Interesting. Euro dollar 120.05 rather. Down about 0.2%. And in crude, briefly topping $60 a barrel. We have a deepening energy crisis in this country, and it's not just about the cold snap for crude either. This one's been building through the last couple of months. 59.95, up 0.8%. That's the cross-asset story. Let's get you some movers this Tuesday morning. From the market desk, here's Kaylee.
Hey, John. Well, a couple earnings movers for you this morning, beginning with CVS. Shares higher by a little less than 1% at the opening bell after its fourth quarter report before the bell. It did beat in the fourth quarter, as did the forecast. At the high-end earnings forecast of $7.55 a share topped estimates. The company also expects $400 to $500 million worth of benefit from COVID-related activities. That includes testing and vaccines. You also have AutoNation up by about 2.3%. Earnings topped estimates. And some news when it comes to leadership. Mike Jackson, the company's CEO, will relinquish his chairman role, though he will stay chief executive. Elsewhere, a nice pop here for BorgWarner, making a voluntary public takeover offer to shareholders of Akasol, which is an electric battery maker for autos. It's higher by around 2%. To the downside, though, Palantir, a stock that had quadrupled since its direct listing 7 months ago, down about 7% at the opening bell, posting another loss in the fourth quarter, adjusted operating loss of around $157 million. Analysts were expecting a profit of $48 million. Finally, a quick check on energy stocks. The sector is leading the S&P 500 early on, with natural gas and oil prices surging because of that energy crisis in much of the U.S. 1.7 million barrels a day in U.S. oil production offline, tightening supply and boosting prices. That's giving a boost to the likes of Exxon. It's higher by nearly 3%. EQT, which is a natural gas player, up by more than 3%. An Energy Transfer, a midstream company, up 1.4%. Phillips 66 higher by about 2%. Is really a broad-based rally across the energy complex, John.
Kelly, thanks. 2 minutes in, it's the energy complex leading the gains this morning, up a third on the S&P. The energy complex up by 2% on the S&P 500. That sector advancing. Yields up, curve steeper. What do you expect? The banks do well. Financials up by 0.8%. Bottom of the pile, real estate, staples, utilities. You get a picture. It's risk on this morning. For global equities, not just US equities, the reflation trade really driving things. Global stocks matching their longest winning streak since 2003. And we had to put this in a graphic for you in writing. It's not powerful enough me just saying it. This from Bank of America, from the Fund Manager Survey. The bottom line, the only reason to be bearish is there is no reason to be bearish. Let's bring in for more Abigail Doolittle. Hey, Abby.
Hi there, John. Well, that's an extraordinary statement, and it seems to match these times where we just have markets going higher, higher, higher. It almost feels out of control. But Bank of America, they also have really interesting findings from that fund manager survey. One saying that risk-taking is at an all-time high. I'm not even quite sure how they measure that, but it does seem to feel match the sentiment. Stock and commodity allocations at the highest in about a decade. Cash levels at the lowest since 2013. What could go wrong? However, they're saying that the economic outlook is the best on record. Easy comps, of course. You have the stimulus, vaccine optimism. So it is risk on, risk on, risk on. And it's showing up in 2021. This after the stellar 2020. If we take a look at a cross-asset look, we're going to see huge gains. There's Bitcoin up 70% in a month and a half, John. Who knew that's possible? Crude oil up 24%. The Bloomberg Commodity Index, which is usually a laggard, up 9%. So that commodity complex continues to rally. And then the Russell microcaps. You were just talking about small caps. It's unbelievable. Take a look at the microcap index, John. In less than 2 months, up more than 29%. Now, one question: when might it end? If it does end, it is interesting, John, because we of course do have the S&P 500 at another all-time high. But you were making the excellent point earlier. We also have that VIX. I know that many options strategists and experts, they do not like to see all-time highs with that fear gauge also going higher. It may suggest some kind of volatility could be ahead, John.
Well, just a massive rush for upside calls. That's been the story over the last few months. Abigail, thank you. Interesting morning. Yields higher, VIX with a 21 handle, S&P 500 at an all-time high, and some people adding, even more so, bullish exposure to commodities. JP Morgan's Monica DeCenso, one of those, and she joins us now. Monica, a privilege to get you back on a program, so thanks for being with us. Let's start there. The willingness to add to commodity exposure, why?
Because of our growth outlook, quite frankly. If you're bullish the U.S. like we are, bullish Europe, bullish EM, how do you not think commodities go higher? But I do want to tack on to what you just heard. You know, we're doing this in a risk-adjusted way. We are using call options. We are using derivatives so that we don't have one-for-one exposure in a commodity that's moved like we've seen so quickly with oil.
Interesting. So, Monica, just add to that a little bit more for me. How are you playing it just in terms of the optionality you're taking in broader assets? Is it through equities? Is it through commodities themselves? Is it through foreign exchange? What's the preference?
Yeah, Yeah, when I have a view on, for example, let's just say oil, I like to play the commodity itself rather than muddying that view by buying a single name, which might have risk to, an executive or labor or something like that. So we have been playing our bullish commodity view through the commodities themselves. Obviously, currencies are another way to kind of play a proxy bet, but I like just playing the commodity outright. Again, you have a lot of volatility generally in commodities like oil, like Brent, and so you can sell a put, going out 6-9 months, and that funds you a fair amount of upside exposure, and that's how we've been playing it.
So, Monica, let's talk about it a little bit more. So you're bullish on the commodities, you're bullish on EM as well, and underpinning both of those themes is a core view that we get a weaker dollar. Can you walk me through that thinking there and how you'd protect yourself just in case that goes the wrong way?
Yeah, we've been balancing, I work with a lot of U.S. investors, right? And many of them are dollar-based. And so I've been having a more regular conversation with them about thinking about diversifying some of their exposure and trying to be a little more balanced and not long dollar through all of their equities and all of their FX. And so we've been balancing some of our equity exposure by taking more bullish bets in other developed market currencies. Another way to do that, obviously, to look at EM equities and take exposure in those local currencies or EM credit ideas. I think that also provides you a good balance. I think in general, we keep hearing everyone's bullish, really everything. That tells me you need to have some balance and you need to have some diversification and probably some hedges on, because when everyone's bullish, I'd be reckless if I didn't have a conversation around hedging.
Well, Monica, you know the story. It's a bit cliche, but it's better to travel than arrive, typically in markets. And we're doing this. We're engineering some of these moves in markets right now before this economy is really reopened, before we've got to that place. And that's what markets do. It's a discounting mechanism. It's about the future, not where we have been or where we are necessarily right now. Monica, do you get the sense, though, that this could be a sell the news event and not just to buy the rumor? You buy the rumor, but when we actually get the news and we reopen, that it's going to be difficult to find those sources of upside surprise to get these additional moves?
I think that's fair because, our bullish outlook is based on earnings growth. We're not betting that you see another 2-3 turns in multiple expansion. And so in a market like the U.S., already up over 5% this year, it's hard to make the case for another 10, 15, 20%. That said, I would easily take another 5 to 10. I'd be very happy if I ended the year there. But again, that's why it's a little more important for me right now to have some protection on the downside. We were talking about VIX a little bit earlier. We saw it close below 20 on Friday for the first time in I think almost a year. Finally, it was getting a little bit cheaper if you wanted to have some of that downside protection on. Didn't make sense to buy it last March and April. Now it does on this rally. I love the idea of taking a little bit of my gains, chips off the table, and buying a little bit of protection just in case the vaccine rollout doesn't go as smoothly, just in case stimulus doesn't come as big as we might want.
Monica, just to finish there, I mentioned this earlier on in the program. I'd love your take as well. I think typically people's relationship is just this sort of more intuitive inverse correlation between, say, the VIX and broad risk assets, the equity market, the S&P 500. This morning, 21 handle on the VIX. We creep a bit higher. Equity market creeping a bit higher. What's the best way of explaining that to your clients?
Again, I think it's all about where you came from. And the question I keep getting as well, rates moving higher. So how, can rates move? Isn't that a bad thing for equities? And I just say to that, it depends on the relative move. If the VIX were at 30, 40, 50, I'd say, yeah, it doesn't make sense. Rates are higher and VIX is there. Same thing for rates. A 10-year at 125, 130 doesn't cause me to rethink my valuations on U.S. equities. 10-year at 2 to 3%, then we're talking about a different world because you finally have an alternative to equities if you do want to get some yield. We're just very far away from that. And so in this scenario, these little moves off of low levels, or even 5, 6, 7% moves off of low levels, doesn't scare me enough to make me rethink the bullish equity case.
Monica, smart. Always good to catch up. Come back soon. Monica DeCenso there of JP Morgan. Thank you. 9 minutes into the session, up 0.25% on the S&P. From the market desk with your movers, here's Abby.
John, let's keep it simple and start out with oil and the energy sector, because this is what is working on the day, and energy, that is the top sector. You see some big gainers there. This, of course, in the energy crisis here. And we have oil back above $60 per barrel, the highest level since 2018. So this piece of the reflation trade really working. That's true, too, for the banks. The yield curve, of course, at its steepest level in about 4 years. Its biggest backup steepening today in more than a month. And on this, we have the banks sharply higher, including JP Morgan, Goldman Sachs, Morgan Stanley, Citigroup, lots and lots of gains for banks as well. So the reflation trade, as you know, very much in charge. What is not working, however, is big tech. So last year's safety and defense really not getting the bid today as investors are looking to these greener pastures, thinking that this rotation into that reopening trade is going to continue without a hitch. Let's see whether or not that happens, John.
Abby, thank you. 10 minutes into the session, stocks are up, record highs in the bond market, 126 on a US 10-year. And an interesting week ahead, just around the corner. Retail sales, Fed minutes, PPI tomorrow morning as well. That conversation with SocGen's Sabaja Rajappa. Up next, this is Bloomberg.
The US is really now growing quite fast and rapidly. It signals that the US economy is going much faster, as I said, which should perhaps have some consequences as regards the famous stimulus. I mean, it seems to me likely that going too far in the case of the US could be a little bit overdone.
Former ECB President Jean-Claude Trichet. We all know what Mr. Trichet would have done faced with the situation that Chairman Powell is faced with this morning. From New York this morning, good morning to you all. Let's bring in Michael McKee ahead of a busy week of data, particularly in the next 24 hours, Mike.
Yeah, we may get some idea of whether Monsieur Trichet has any idea of what he's talking about in terms of the strength of the U.S. economy. We did get one number this morning, Empire Manufacturing, State of New York. It does show some small gains in manufacturing. The headline number goes up, number of employees go up, and so do the new orders index, but not very much. The biggest change there is a jump in prices. We'll keep an eye on that. It is a week of Fed speak, and we get the Fed minutes tomorrow, or Wednesday rather. The question is, do they matter? That was 3 weeks ago, and now we've got all these Fed officials coming out this week to talk about the economy. They'll all be delivering the message that we heard this morning from Jim Bullard of St. Louis. We are not even thinking about raising rates or getting rid of QE. So keep an eye on what the Fed has to say, but probably not going to be a lot of news in that. There will be more news in the economic indicators, and that's what we keep our eye on here for a couple of reasons. One, because we want to see how fast the economy is rebounding. We get retail sales and industrial production. Both of those on Wednesday could be really important in the sense that we normally see retail sales drop in January after a big December and November spending, but November and December spending wasn't big. So what happens, plus the fact we got those $600 checks that went out, so did people spend more in the month? Unusually weak month, but now maybe a little bit stronger. And here's the other reason we're going to watch what's going on out there. The last time we had a cold snap like this, 2013-14, you can see what happened to the economy in the month of January, from December to February, basically. Big drops in just about everything: retail sales, housing starts, industrial production. That could put a crimp in first quarter GDP, which is usually already seasonally the weakest quarter of the year. So it just means the hole that much bigger. Long term won't make a difference, but in the short run, the hole's bigger and it's harder to get out of.
Mike, what's the cheat guide for the Fed? Whatever happens from here on out through the rest of the year is transitory and we're going to stay pat, do nothing?
In terms of economic data, that's pretty much the story, John. We do have some issues coming up with cash management at the Treasury that's going to make it harder for the Fed to control interest rates at the very short end, which may raise some questions in the markets. But other than that, it's going to be watch what happens, but look past it at this point.
Mike, let's talk about looking past things and get to the 10-year yield this morning. 126, are we, on a 10-year? Right now, yes. North of 2% on a 30-year yield as well. Mike, I think everybody's trying to work out, when does the Fed get uncomfortable with this? And so far, given where stocks are, given where credit is, given where the supply has been going and how well it's been taken down, hard to make the argument they're stepping in anytime soon.
No, they're not going to. They're watching this, but they don't think at this point there's a whole lot they can do. I mean, whatever they do would have such an effect on the markets that they're going to keep their powder dry. A 1.2% 10-year rate isn't going to slow the economy, really, and so might as well just let the markets play out.
You would argue this is what they want to see. Mike, thank you. This might be what they want to see. Yields are up at the long end, pinned at the front end. Pinned at the front end, that's important. And to Mike's point, there's some technical things going on here, and yields at the front end could actually go lower. We'll talk about that later in the week. So yields higher, curve steeper, financial conditions loose, 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 dollar weaker, equities rallying, credit spreads tight, tight, tight. Whoever comes to market can raise capital. You might say it's gone too far too quickly, but that's been the story. Now, if you start to see simultaneously yields up, financial conditions tighten, then I think that Fed speak starts to sound a whole lot different very quickly later in the week. But so far, where we're at right now, I don't think these guys want to change. This is the story for the broader market. The equity market, a drift higher. We add to the gains, all-time highs. Let's get some sector action and get across to the market desk and catch up with Abby.
Hi there, John. Well, it's not just risk on right now. It's also a classic sector composition on the day. If we go into the Bloomberg terminal and use that IMAP, we are going to see that risk on picture that you're talking about. Up top, not surprisingly, we have energy and financials, energy in sympathy with the energy crisis, up 2.4%. The financials also sharply higher as the yield curve steepens and yields back up to levels seen not in a year. Bottom, this is what's making it so classic. Because yields are so much higher, the dividend-rich sectors such as healthcare, utilities, real estate, and staples, that's where your dividends are. Those sectors are down because those dividends simply don't look as strong, as attractive when you have yields higher. So you have some competition. So it's interesting to see this kind of diversification that we have not seen in quite some time, frankly. And then on the year, John, just to show that what's working today is also working on the year, take a look at that. The S&P 500 energy sector up about 20% on the year. The financial sector itself up 7.8%. And then those regional banks that do so well from their lending business, so they really benefit when yields climb, that's also up nearly 20%. Pretty stunning in such a short period of time.
Crude up, yields up, and that's the outcome in the equity market. I keep doing this. It's February 16th, and they are the year-to-date numbers. Unreal. So Badri Rajappa of SocGen just publishing a little bit earlier. Let's bring you a quote from that research just quickly. Quote, the reflation trade seems to be propelling yields higher with little impact of broader financial conditions. Whether this continues will be highly dependent on the feedback loop from high yields into the broader economy and the Fed's willingness to let yields continue to rise. Let's build on this. So Badri joins us now. So Badri, thank you very much for joining us. Let's start there. Through 125 on 10s, through 2% on 30s. Are the conditions in place for the Fed to be tolerant of these kind of moves?
I think we'll find out this week when we get a bunch of Fed speakers who are going to opine on this topic. Thus far, we've not seen any sort of reaction in risky assets. Both equities as well as corporate bonds seem to be holding up despite the sharp rise in yields. It's also kind of a technical